data undershooting forecasts, but also separate figures are showing that U.S. housing market continues to cool. There was another report highlighting that consumer confidence unexpectedly fell. So if you put that all together, it means that we could see a much more cautious Fed. And overall, the central bank is set to unveil 25 basis point rate increase. Investors, of course, keenly parsing Jay Powell's notes to give us an indication of what he's expecting to do next. Equity futures pretty much unchanged, slightly on the upside, so we're seeing a bit of green, gaining 1.2% higher, and then I would suggest it's really the foreign exchange where we're going to see the biggest moves. Watch out also for sterling, 123.21, as we have the biggest strike day in over a decade in the UK. Schools are closed and about 475,000 people are expected to strike. Overall, the S&P future is also unchanged. Again, it is the Fed. We'll talk about decision day. I have two notes I want to bring to you. First of all, we had an interview with Jeffrey Gundlach, and then there's also Bank of America talking about the Fed fund rates, crude oil 79.35. Now let's get over to our Bloomberg MLive managing editor, Mark Cudmore. Mark, good morning. You're looking at U.S. data, of course, as we await this all-important Fed decision.
Yes, good morning, Fran. I want to show you two charts to kind of put the Fed decision in context. First of all is the core PCE chart. Now this red line you can see is the highest measure we ever saw in core PCE year on year over the last almost 30 years, and that is at 2.6%. We got to more than double that. We're at 4.4% now, still more than double the 2% inflation target. There's two conclusions to draw. First of all, we haven't seen anything like this recently. The last time we saw something like this, it was back in the terrible inflation eras, the 70s or 80s. That should be worrying. The second conclusion is 30 years since we've seen something like this. This means that most economists, traders, investors, policymakers have not really actively, professionally worked during an era of much higher inflation like we're seeing today, which kind of clouds the judgment. Now, this kind of chart might suggest that Powell needs to be very, very hawkish today. But let me show you the next chart, which is core PCE minus the upper bound of the Fed funds rate. We finally got back to 0%, actually minus 0.08%. This is the December reading. As of today, in fact, we'll now get that will be negative, i.e. inflation will be below the upper bound. Inflation as measured by core PCE. That sounds like a good sign. A few other conclusions again to draw this. The only other time that we ever went as high as we went last year was back in the mid-70s when we headed that horrible stagflation kind of cycle. Another quick conclusion is that during the subsequent period, after Volcker controlled inflation, we got used to the idea that policy rates should be above inflation, and that was kind of assumed because inflation was the big threat. We had growth, it was fine. Then we transitioned to a world from the mid-2000s, hammered home by the crisis, the 2008 crisis, where we only worried about deflation, and it was assumed that policy rates would be below inflation. And I think that many investors, traders today, assume that's the case now. So now that this is near 0%, they're like, whoa, Fed, back off, ease up, give us some support. Perhaps, though, this isn't the era. Perhaps this is more like the era we should think about where growth is okay, the bigger threat is not deflation but inflation, and we should get used to a world back like here where it was normal for policy rates to average a couple of % above inflation. For that to happen, we either need inflation to continue collapsing at a tremendous pace this year like never seen before, or we're going to need to see some more rate hikes later on this year. The jury is still out.
The jury is out, and our Mark Cudmore will be all over this. Our Bloomberg M-Life Managing Editor, Mark Cudmore. Now, joining us is also Valentine Enus, Deputy Head of Developed Market Research at Amundi Institute. Valentine, thank you for joining us.
Hello.
What's your main takeaway from what we could hear from the Fed and what it means for markets going forward?
Yeah, so regarding the Fed, we expect the net rate hikes to be at 25 basis points in line with market expectation. As you have just shown, data supports smaller rate hike. There is a significant decline in 3 months and 6 month inflation. But at the same time, we expect the Fed to continue to deliver an hawkish speech. We continue the Fed, Jerome Powell, to say that we will have higher rate for longer, that the job is not done yet for inflations. So what is really important now is not really the terminal rate. I think it will be 5.25. We are there. But what is important is how long will the Fed maintain interest rates in restrictive territory, when the Fed will shift its focus from inflation to growth. We are not there.
Valentine,
The Fed...
Yeah. I mean, on that, Valentine, the problem we heard also from Jeffrey Gundlach is that the markets, they've gone from 4 hikes of 75 to 50 basis points, of course, in December, to now possibly 25. Are the markets going to believe that there's again a Fed pivot? And what does Jay Powell need to do to push back against that? Will he push back against that?
Yeah, it was market expectations. Yeah, it was not really quite efficient to push back market expectations. Really, he wants. We think that the market is really too optimistic when the Fed will start to cut rates. We expect the first rate hike at the beginning of 2024 and not in 2023. I think if we are looking now at the labor market remains very, very tight. We continue to have a strong labor shortage in leisure and hospitality. And wage growth, we have some signs of moderation, but wage growth is still not in line with an inflation that could remain sustainably at 2%. And the other important point, and that's a major uncertainty for the Fed, is the impact of the reopening of the Chinese economy. And on the top of that, calling for transitory inflation was a really bad move from the Fed, and they could not afford to be wronged for 2 consecutive times. So we definitely see lower pressure on the Fed, but we expect the Fed to continue to remain very cautious, and I think that the market at some point will have to adapt.
So do you think, Valentine, for the moment, the markets are too optimistic about a Fed pivot? Are we going to see a correction in the markets after we hear from Jay Powell?
Yes, I think the market is too optimistic, but I'm not so sure that the market will listen right now to Jerome Powell. Maybe it will come a little bit later. Because I think that the market now is really confident when it's looking at the economic activity, at inflation, but at some point we will have some correction on market to be better aligned with what the Feds will do. But what is really, I think, interesting in the US is that you have growth is going down, you have inflation is going down, and maybe what the market is underestimating is the impact of the monetary tightening on growth. So, and this, I think that the market is also a bit too optimistic.
And Valentine, you laid it out. I mean, we talked about core inflation. We talked, of course, about wage inflation. We talked about some of the other things in terms of terminal rate. Where do you see financial conditions being in the U.S., and how could that, again, impact the markets thinking about what Jay Powell says?
financial conditions are easing, and this is another risk for Jerome Powell if we have too much easing in financial conditions. But if we look into details, financial conditions are really easing, but if we look at bank financial conditions, they are really also tightening and to some extent, and real yields are also in a restrictive territory across the curve. So yes, we have some tightening in financing conditions, but maybe later in the year the picture could change. And so far, the impact of the monetary tightening on corporate fundamentals has really been limited because companies have used the cash accumulated during the COVID, and the refinancing needs were quite low in 2022. But this will change, and this year companies will have to issue more and at a higher rate. So that could also change the picture.
Okay, Valentine, thank you so much for joining us. Valentine Hainaut is Deputy Head of Developed Market Research at Amundi Institute. Now, this is a picture across the board. We have individual stocks that we really need to spend a bit of time on. Credit Suisse is one that I would also suggest to keep an eye on. We have two Bloomberg scoops on it, one on how they're planning to deal with Credit Suisse First Boston. The other one is how they will deal with, of course, the Andani, some of the bonds that they're holding in that. We also are going into earnings season. Novo Nordisk, one we need to definitely keep an eye on, and Novo Nordisk forecasts a record profit. This is fueled by some of expectations on their drugs to deal with obesity. GlaxoSmithKline, you can see gaining some 0.6%. Coming up, Bloomberg has learned that Credit Suisse has stopped accepting Adani bonds as collateral for margin loans. So more on that next, and this is Bloomberg.
No one can claim that climate change is somebody else's problem or shrug it off for future generations to address. We're all affected by a warming planet. We see that every day. And decisions being made right now will determine our shared tomorrow. So we must choose, and we must act as united nations ourselves. Our progress depends on collective action, on collective ingenuity. If we stick together, we can make fixing the climate the greatest project and greatest achievement of our lifetimes. We have the science, we have the solutions. Now all the world needs is political will. Together, we can create a future where rampant carbon is removed from the atmosphere, where green buildings and green business transform the livability of communities.
The top names in business are on Bloomberg.
More and more people are frightened of the realities of today, and that's manifesting in so many areas. Why would anybody put something into a 30-year obligation unless you believe something is better in 30 years? I'm not here to suggest it's going to be rosy in 2023, but what I'm saying for long-term investing, it's a better environment for long-term investing today than it was 2 years ago.
Nobody covers business like Bloomberg, your global business authority. From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
Welcome back to the Open, everyone. 12 minutes into the European trading day. The picture is one of markets trying to figure out what the Fed does next. Frankly, 25 basis points now, of course, priced in. We look at some of the data points. Our Valerie Teitel put the great charts. There are 4 charts that you really need to know about. This is wage growth. This is, of course, some of the inflation and what we know about financing conditions. But the main question is, are the markets going to take this as a pivot, and how much will Jay Powell push back against that? Now, Bloomberg also understands that Credit Suisse has stopped accepting bonds of Gautam Adani's group of companies as collateral for margin loans to its private banking clients. Scrutiny of the Indian tycoon's finances is growing after allegations of fraud by short seller Heidenberg. Well, Adani denies the allegations. Let's bring in Bloomberg's Tom Metcalf. So, Tom, good morning, and thank you so much for joining us. I mean, this is the first indication, I guess, that something with Adani could hit the financial community further afield, right here in London and in Zurich.
Yeah, absolutely. It's a fascinating scoop and very telling. So this is Credit Suisse private bank. It's basically no longer accepting as collateral, like cut it down to 0%, any of these companies. And it's a mixed picture because we think this is basically the first bank to do this, but obviously adds to the turmoil here, raises more and more questions. And it just is a very clear reminder that, there's no way Adani is out of sort of the woods here, despite raising 2.5 billion yesterday. I think this saga is going to run and run.
So do we know, Tom, the relationship, first of all, of Credit Suisse and some of the, I don't know whether it's loans, and can you explain if there's a big margin call on the product, could it take banks down with them?
Yeah, so in this case, what Credit Suisse is saying, so it's for the wealthy people who might indeed hold shares in Adani and might want to borrow against them. And Credit Suisse basically used to say, okay, you hand over those shares and we'll give you 75% of that value as a loan. Now it's saying we will take nothing on that. We understand other banks are still providing that kind of product. So it's quite sort of isolated, and given it's individuals, you expect it's not going to sort of be kind of systemic or anything like that. But, of course, if you look at what's happening in the share price, you look at kind of all the sort of turmoil around there, it could very easily spread. So for me, I'm looking at this going, wonder what will pop up next, because surely you think other banks will look at this and go, maybe we should be a bit more risk-off.
So what does happen next when you look at some of these credit products?
Well, I think all eyes need to be on the stock market. So I think Adani, again, has hit its sort of limits in terms of falling today, down like 10%. That's a problem because basically a lot of these loans, not just the ones at Credit Suisse, will be tied to basically the stock value. So if the stock value keeps on dropping, then you might start to see more and more margin calls. You might start to see more moves like this. So what Adani needs to do is sort of reassure investors, make sure those shares stop falling. And what people like Hindenburg are saying is, guess what? It's keep on going to fall, and this is going to get a bigger and bigger problem.
Tom, I know you and the team are hitting the phones to try and figure out exposure, but do we know of any big banks having a more direct exposure to Adani?
So what we've heard so far is most banks saying, nothing to see here. So we had UBS results yesterday. I think the CEO came out and said, I can't comment, but don't worry about it. So look, the best sense I have is it's, maybe certainly for the big European banks, it's more like hundreds of millions perhaps in the exposure. But no one's really come out on the record and said, hey, this is it. And so there's probably, a fair few skeletons in the closet, and we'll probably find out in due course, I hope.
Tom, thank you so much, as always, for all of the insight. Tom Metcalf there, who runs all of our European banking coverage. Coming up, the UK's rail network grinds to a halt. How can the government bring the latest industrial action to an end? We'll have plenty more on that next, and this is Bloomberg.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. And the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. what would you say that person should do with $100,000 to put in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
News breaks. No one covers the world like Bloomberg.
The return to pragmatism is really that everybody's in line. The government, the enterprises, the people, in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt, with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Welcome back to the Open, everyone. 18 minutes into the European trading day. There's one thing that we need to look at today. It's decision day for the Fed. So we look at core inflation, some of the main market themes. Of course, core inflation has moderated. Wage inflation, that's also moderated. Financial conditions, are those too loose for Jay Powell? And then finally, we look at market pricing of the terminal rate. Widely expected 25 basis point hike from the Fed. Now, nearly 500,000 UK workers are due to walk off the job today as part of the country's biggest coordinated strike in a decade. Significant disruption is expected with teachers, civil servants, train drivers, and border workforce workers taking part. Well, Bloomberg's Tom McKenzie is at London's King's Cross rail station, where he's joined by guests. Good morning, Tom.
Francine, good morning. Thank you very much indeed. Yes, as you say, around 500,000, around 500,000 people with the mandate to strike. We're here, of course, at King's Cross, a major transport hub, not just for the capital, but for the UK as well, where we are expecting to see just 20% of services across the UK running in terms of railway services. But as you say, it's also civil servants, about 100,000, and importantly, teachers as well. Now, as you mentioned, we are pleased to say we're joined by the Assistant General Secretary for the Trades Union Congress, which has played a significant role in today's action. The biggest strike action, arguably, for at least a generation, or at least a decade, I should say, here in the UK. Kate Bell joining us now. Kate, thank you for your time. What is today's action? What does it do in terms of moving you closer to the achievements, or at least the goals that you're hoping to achieve?
Well, look, there's two things happening today. We are having a day of action about protecting the right to strike. The government is trying to ram through some legislation through Parliament, which would fundamentally restrict that fundamental British liberty. And we're showing just how strong the support for the right to strike is in the UK today. And then, of course, many workers across the public sector are standing up for their pay and conditions. You know, we hope that industrial action is something that is going to make the government listen, realise it needs to negotiate and give those public sector workers the pay rise they deserve.
And the government's response, and we've heard it repeatedly, they're sticking to this line. If they go with these double-digit pay rises that are being demanded by many of these unions, it will only entrench inflation across this economy and cause greater pain for households across this country.
Well, I think that argument has been pretty comprehensively demolished. You know, we've got pay in the public sector rising at half the rate in the private sector right now. And what these unions are asking for is a negotiation with government about decent pay rises after a decade of pay restraint. I think there's no evidence that we're in any risk of some kind of wage price spiral, or that giving teachers, civil servants, rail workers a decent pay rise is going to fuel the inflation, which, as we know, is coming from global factors, as in other contexts the Chancellor has been very keen to emphasise.
It is tricky to quantify the economic damage, but the CEBR, they came out with an assessment that you're looking at about the industrial action up until today, not including today, about £1.7 billion. UK hospitality saying they've taken a hit, their sector, of about £2.5 billion. Is there a limit in terms of the economic damage that the unions are prepared to inflict on this economy? Is there a line that you won't cross?
Well, I think it's the government. You should be asking the government that question. You know, when we talk to businesses, they tell us they don't understand why government isn't sitting down to negotiate with unions. What we see across the private sector is we have seen industrial action, and we've seen a lot of tough negotiations in the private sector this year. But what we've seen is those businesses negotiating with unions and coming to some decent pay settlements which reward their workers. And I think what business are asking is, why are government not capable of negotiating the same pay rises that those public sector workers deserve?
What is your assessment of where those negotiations stand? Of course, talks happening among and across a number of sectors with a number of different unions. Is the needle moving at all, or is this a government that's digging in?
Well, you know, I'm not across the detail of every single negotiation. You know, those are our unions conducting them directly. I think one of the worrying things is that the government still seems to be refusing to negotiate on pay for this year, which is, of course, what those disputes are about. And the Prime Minister and the Chancellor, who do have the power to unlock these disputes, appear to have gone missing in action. You know, we've asked them repeatedly to sit down with us. They don't seem to be concerned about the damage this is causing to public sector workers and our public services across the economy, of refusing to deliver a decent pay rise that those people deserve.
Many of the workers striking today, many of those on picket lines, will not be receiving pay for today. There's a point, surely, where these workers are going to have to be going back to work, that they can't continue to strike indefinitely because of the hit to their own personal finances.
Well, look, it's a tough decision for every worker to go on strike, and, you know, one they will have thought very carefully about, but they have got to the point where they feel there's no other option, basically. They've tried negotiating. Take the teachers, you know, they were raising these issues back last summer, and the Education Secretary or successive Education Secretaries refusing to sit down and talk to them. And so this is a really difficult decision for those workers on strike today, but it's one they've taken because they've been pushed to the last resort.
Today, the first day where we've had coordinated union action in this period of striking and industrial action across the UK, can we expect further coordinated action from the TUC, from other unions in the months ahead here in the UK?
Well, look, every decision to strike is a democratic decision for the members in that union and for their own unions. And I think what we're asking for today is for the government to come and negotiate decent pay rises. That's what we need to stop this industrial action and to get people the pay rise they are asking for and they deserve.
Clearly not ruling out further coordinated action.
Well, look, you know, every union takes its own decision about whether to go on strike or not. Those are discussions that are going to be ongoing, and it's up to the government now, I think, to come forward with a credible pay offer.
Okay, there we go. Kate Bell, thank you very much indeed for your time. Kate Bell, the Assistant General Secretary of the Trades Union Congress. Just giving a sense there of how the unions are thinking about the industrial action today and what, of course, they want to hear from the government. Francine.
Tom, great interview. Thank you so much for joining us. I have to say, the announcement at the station stresses me out, Tom. Even if I'm here in the studio, I feel like they've canceled out the train. So good luck to all of the commuters. I'm not sure there are many at the moment. Now, several pharmaceutical giants are reporting today, including Novo Nordisk, which is forecasting a record profit this full year. Joe Easton from our equities team now joins us. Joe, good morning. What do you have for us?
That's right. So we've got three big pharmaceutical stocks today. As you mentioned then, Novartis, that one looking like it's a bit lower today. That looked really strong to me this morning when I first looked at it. Their EPS was beating by around 10 cents. But according to Citigroup, those analysts are saying that was underwhelming. Apparently some of their arthritis drugs and also their spinal treatments just not meeting those analysts' expectations. That's taking a sting out of that top line beat that we had. But a lot of the focus today is over on Novo Nordisk in Denmark. Now, this is the third biggest stock in the Stock 600, around 2% of the index, $320 billion in market cap. That's doing really well because of their obesity drug, Wegovy. This is flying off the shelves. They're competing with the likes of Eli Lilly and Pfizer over in the US. It's been keenly anticipated. Analysts have been talking about this drug for a while. Promises to shave around 15% off a person's body weight. It's an injectable treatment. As we can see, that stock up 1.5%, which is a pretty big day for a stock of that size. And then the third one we're looking at is here in the UK, GlaxoSmithKline. Again, a bit of a beat on the top line for them. Their EPS as well is expected to rise as much as 15% this year for Glaxo, known for their shingles vaccine. That stock only up around 0.2%, as we can see on the screen here. They're waiting for some key approvals to come through Glaxo. They're waiting for one of their iron deficiency treatments, and also some of their respiratory drugs haven't yet gotten approval here in Europe And the big overhang for that one at the moment is the Zantac litigation. That caused a bit of a storm last year, some potential problems with that. So perhaps with that one, a few investors waiting on the sidelines.
Thank you so much.
To try and see how that comes through.
Joe, thank you so much. And later on, we'll speak to the Novo Nordisk chief executive.
To name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Count Under the Close.
Welcome to Bloomberg Crypto.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Cementing the downshift, slower gains in U.S. employment costs pave the way for a quarter-point hike by the Fed today. Winter of discontent, the UK's worst industrial action for a decade, shuts schools and cripples its rail network. That's as 500,000 people strike over pay. Plus, Bloomberg has learned that Credit Suisse will not accept Adani bonds as collateral for margin loans. It comes as scrutiny of the Indian tycoon's empire grows. We're also getting some breaking news out of Adani Enterprises, plunging by the 10% daily limit as the sell-off seems to be extending. Now, there's quite a lot going on in the markets overall, but I have to say a pressure point or something that we need to keep an eye on as a source of stress is what's happening in Adani. And we need to try and understand, and I know our reporters are working the phones, of course, not only the collateral, but some of the margin calls that could ensue from Adani. Overall, European stocks, U.S. futures are both mixed ahead of the Fed, so it's all about the Fed. We have some key economic data, of course, company earnings, but it's really the policy meeting from the Fed that will overshadow absolutely everything. Now, we did see wage cost data undershooting forecasts. We had separate figures showing U.S. housing market continuing to cool, and then we had another report highlighting consumer confidence unexpectedly falling. So if you put all of that together, a picture is probably a 25 basis point hike, and then we look at financial conditions, and it's really the words that we'll try to keep on top of so the market understands what Jay Powell could do next. These are the groups that are moving the most. We do also have some earnings reporting, but overall in the markets, really it's what central banks will do, and then we'll go on to the meeting tomorrow from the Bank of England and the European Central Bank. Travel, leisure, auto parts, financial services gaining about 0.8%, and we have one group out of the 20 on the downside, and that's personal consumer, down 0.1%. So the February FOMC meeting is finally here. Another downshift in the pace of rate hikes to 25 basis points, widely expected. For markets, it's all about Jay Powell's opening statement and tone in the press conference. Joining us now is Bloomberg's Valerie Teitel. So, Valerie, the decision guide to the Fed, what are you watching today?
Look, the key thing off the bat, Francine, is to look in the third paragraph of the opening statement. Any evolution in this statement when he talks about ongoing increases in the Fed funds rate. Now, this is the statement from December. It does seem a little stale now, especially in light of the wage inflation moderation you mentioned and the moderation in core inflation. So some evolution is likely, possibly acknowledging the gap between the Fed funds rate and the peak has shrunk. But there's a lot of belief out there that he'll push back yet again on all these cuts we've priced out to 2023. Perhaps some addition in this opening statement that he intends to leave the policy rate at sufficiently restricted levels for an extended period of time. That could also be another addition the markets could react to in the opening statement.
So, Valerie, hawkish or dovish surprises? What are markets betting?
Look, for a hawkish surprise, he's going to have to convince markets that the May hike is still alive. A way he can do this is to really kind of dismiss the recent drop in inflation, almost doubting it in some manner that because the labor market has stayed so strong, and he could repeat that the Fed has some ways to go. If he wanted to come off a slightly dovish, he's going to have to really open the door for a May pause. He could acknowledge the recent drop in inflation as welcome. That, along with the fact we've had some softening in the economic data, he could say that the rates are approaching a sufficiently restricted level and declare yet again that they're data dependent. This would be not necessarily declaring victory, but leaving the door open for a possible pause in March.
Valerie, thanks so much. Bloomberg's Valerie Teitel. Now we're joined by Samuel Zeef, head of global FX strategy at JP Morgan Private Bank. Sam, great to speak to you. I mean, this is Fed Day. Are we excited? Are you like hyped up?
Always, always.
The market believes there'll be a pivot. How aggressively will Jay Powell push back against that?
I think verbally he will, excuse me. It's just not in the Fed's interest to have financial conditions easing this early. I think if they had their way, they would have, they're going to have one or two more hikes, and then financial conditions would just kind of be flat, be uninteresting for a few months, buy them some time. And then I do think in our outlook, the labor market, because of how sufficiently restrictive policy has gotten, the labor market will start to crack around the turn of the year. We do think the unemployment rate will start to rise. Put that together with what we've seen on inflation, on wage data. By the end of this year, we do think the Fed will be on their way towards easing policy.
Yeah, but financial conditions change everything. So what exactly are you expecting from Powell?
From Powell today, I would expect him to, as Valerie laid out, I do think that he will push back on the amount of pricing that's priced in, the amount of cuts that are priced into the market. I do think he'll leave the door open to further hikes, particularly if financial conditions ease in response to today's meeting.
So what happens, are you actually expecting an easing or a cut at the end of the year?
Cuts by the end of the year, predicated on our outlook for the economy to continue to weaken quite aggressively.
But so this would be, I mean, is this something that they have tried to engineer, or if they do a cut, does it mean that they've overhiked?
I mean, it's an interesting question. It means they've overhiked, but because that's what they have to do.
Right.
They waited probably too long last year to hike rates. Inflation has overshot, and we don't think, and the Fed doesn't think, that inflation can sustainably stay at 2% unless the labor market cools. And to cool the labor market, from what we're seeing, you need the unemployment rate to rise, and you need some pain in the economy.
So, Sam, what do you think? What are you expecting dollar to do?
Today, that's anyone's guess. I would guess that the dollar's the weakening trend, I don't think, is really going anywhere. If you think about the global environment and particularly how it's evolved over the last 8 weeks, you still have cooling inflation in the U.S., a weakening economy in the U.S., but globally, global growth actually looks to be on a better footing with China reopening. Europe is going to avoid a recession, we think, in 2023 now. Nat gas prices have fallen significantly in Europe. And you put those together, we've always thought the U.S. would catch down to the rest of the world in 2023, but it actually seems like the rest of the world might be also at the same time catching up. And so we do think euro-dollar heads to 115. We do think that the dollar has another 5% to go in 2023.
And I understand that the China reopening is seen as a positive. We see more trade. Some of the supply chip constraint can ease off. But how inflationary will this be?
So we come in the camp that it's on net, probably slightly disinflationary rather than inflationary. It will be interesting for Europe, but at least when we think about the U.S. and the U.S. situation, because it will help supply chains ease, on net it's disinflationary. But just when I think about the U.S., I think it really is key. When you narrow in on the type of inflation that's left in the U.S., it is core services, ex-housing, the labor market-driven things. In Europe, yes, very much so, the labor market is less tight. Inflation is much more driven by energy prices. So if China reopening does put some pressure on energy prices, it could be a bit more inflationary in Europe.
Yeah, and I understand. I understand also that we could have reached peak inflation in the U.S., but food inflation is not something to forget in the U.S. And so it's putting pressure in the cost of living in key parts where you could see an economy that we weren't really expecting.
It is, and it's in the background. I don't mean to dismiss it by any means, but when we've kind of sliced and diced all of the inflation data, bottom up, top down, we're really focused on the labor market, almost laser focused there.
Sam, what's your target for dollar from here until the end of the year?
So in euro dollar, let's say, it's about 115. We were always looking for, as I said, the U.S. to kind of catch down to the rest of the world. That meant 110 to us, but really over the last 4 to 6 weeks, considering how the global growth environment has shifted, we're marking that up to about 115. On DXY, call that 97.
And so that would benefit a lot of the emerging markets.
So the real core of our view, we get this question all the time whenever I say the dollar is going to weaken.
What about emerging markets?
Yeah, exactly. The real core of our view is, again, narrower rate differentials between the U.S. and other developed markets, particularly developed markets that had negative yields for a very long time, like in Europe. We think that leads to some investor rebalancing from what had become, in recent years, very heavy U.S. overweights. We think that benefits the low yielders, yen, Swiss franc, gold, euro. When I think about the global growth environment, it is improving. But when we look at our models, it does seem like the dollar's already embedding a good 1 to 2 percentage point improvement in the global growth outlook. So when I think about the best risk reward in short dollar positions, it is against these lower beta, low yielding currencies rather than the real risk on currencies.
Sam, are we underestimating the U.S. debt ceiling and how ugly that could turn?
I don't think we're underestimating it because everybody is starting to focus on it. I do think the stage is set for perhaps the most contentious negotiation, let's say, since 2011. I won't prognosticate on what the actual outcome is. I have to assume something is worked out eventually. But what we did see in the 2011 episode is dollar underperformance against these alternative safe haven currencies in the months leading up to it. I just laid out the case that I'm bullish all of those currencies in the first place. The debt ceiling is just another reason for me to have conviction in that view.
What are you expecting the ECB to do tomorrow?
We think 50 basis point hike is totally baked in, so that's not going to be particularly much of a surprise. I do think Lagarde's President Lagarde, excuse me, her messaging for the next couple meetings will be most important. We continue to see, we've gotten some mixed inflation data, but in our mind, risks on the inflation front in Europe are still decisively skewed to the upside in the near term. So we think they'll maintain a pretty hawkish stance. We think they'll at least get the terminal rate up to 3.5%.
Do you think the Eurozone can avoid a recession at this point?
We do. And that's really come down to the back, or on the back of nat gas prices falling considerably. It doesn't mean that there won't ever be a recession. It's certainly delayed. And if the ECB is going to be going into further restrictive territory, it will put pressure on European growth. But when I think about our forecast horizon over the calendar year of 2023, where we had a recession at the early part of 2023 in our numbers originally, we've taken that out now because of the fall in energy prices.
Sam, thank you so much for joining us. Samuel Zief, there, head of global FX strategy at JP Morgan Private Bank. Now, coming up, shares of Snap plunged in the post-market trade after the social media company forecast its first ever quarterly revenue decline. We'll break down the numbers and see what's ahead for the tech sector next. This is Bloomberg. Amazon acquired Zoox back in January 2020 for what reports suggested was $1.2 billion. Since then, the company has revealed its Zoox vehicle. This is, I think, a rectangular passenger-focused vehicle with no driver's seat or steering wheel. How would you describe it?
We describe it as a purpose-built vehicle, but it's really a robo-taxi. That's its purpose. And essentially, it's about transporting people from point A to point B on demand in the most effective, cleanest, and most enjoyable way.
So why won't you call it a car?
Because a car is, there's an inference that there is a driver. Whereas in our robotaxi, there is no manual driving. A human cannot really drive it to transport passengers. So we want to make sure that that mindset, that shift, that distinction is clear.
As growth forecasts are increasing and inflation is falling, will the European Central Bank make its fifth rate hike in a row? How high do rates need to go? Bloomberg Television and Radio brings you the breaking news from Frankfurt and detailed analysis after ECB President Christine Lagarde's press conference.
The central banks, and certainly the ECB is pushing this line, have got much more wood to chop. They've got much further to go.
Coverage begins Thursday, only on Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Welcome back to the Open, everyone. We are 43 minutes into the European trading day. The picture, we're seeing gains, more gains than we saw certainly at the Open, where we're pretty much flat. But the focus is, of course, on earnings. The focus is on the Fed. What the Fed will do, the market pricing in a 25 basis point hike, and then it's all, of course, not only the opening statement, but some of the subsequent speeches that will give us an indication of tone from Jay Powell. Now, Snap is forecasting its first ever quarterly revenue decline, citing a flurry of changes to Snapchat's advertising products that may be disruptive to its business. The projection sent its share price plunging as much as 16% in after markets trade. While Bloomberg technology reporter Aggie Cantrell joins us from Berlin. Aggie, good morning. Is Snap's forecast a sector-wide problem, especially those that rely really heavily on ad sales and revenue?
Absolutely, Francine. So yes, we're seeing Snap is potentially a bellwether for what's to come for the other tech earnings that rely heavily on ad revenue going forward this week. But to look at Snap specifically for a second, it's also worth pointing out that Snap has a very young user base, and also that while they've seen a lot of user growth, they have also seen that user growth outside the US specifically. And so a lot of that user growth outside the US is potentially people without the same buying power as people inside the US. So that is a concern for the company. And really, while they're seeing this user growth for Snap, it's really a question of how they're able to turn that user growth into ad revenue. But if you look at how it affects the broader sector, we're already seeing it. Last night in extended trading, while Snap saw a drop, so did Meta and Pinterest, companies that are also looked to in terms of what they're going to be doing with their ad revenue, whether they're going to be able to make the sales that they wanted to for this quarter and for the last quarter.
Aggie, I think you called me very young. I'm a Snapchat user. Meta earnings are also due. What should we focus on there?
Exactly. I mean, when it comes to Meta as well, the real concern is also that the ad revenue is the core of their business model. From 2015 until 2021, every second dollar spent on online ads was spent on Google and Meta. That has now shifted somewhat as other people are getting in on the game. We're seeing Amazon, for instance, trying to bolster its ad revenue, and also Apple as well. And also, of course, with Apple, there's also the other aspect that a huge amount of ad revenue online is based on data, and Apple managed to change its user agreements to cause these tech companies, these other tech companies that use iPhones to provide those products and collect data from their users. They have now pushed for users to be able to opt out of this data collection or aspects of that data collection on Apple products, and Apple is also looking into this ad revenue. So all of this means that the typical
legacy players in this online ad revenue space, Meta and Google, are now being squeezed out as well. Not completely, of course, they're still incredibly powerful within this space, but it is a concern for the companies going forward.
Aggie, thank you so much, as always, for all of your time. Our Bloomberg technology reporter, Aggie Cantrell, in Berlin. Now let's get straight to the Bloomberg First Word News with Alice Atkins. Hi, Alice.
Hi, Francine. Widespread industrial action will close schools and cripple Britain's rail network today. Close to 500,000 union members are set to strike, demanding pay rises to catch up with soaring inflation. A walkout by teachers will see most schools shut or partly shut, with several major train stations in London also completely closed. Bloomberg has learned the private banking unit of Credit Suisse has stopped accepting Adani bonds as collateral for margin loans. Credit Suisse was listed as a backer in Adani's rebuttal of the Hindenburg research fraud allegations earlier this week. The move is another sign that scrutiny of the Indian tycoon's empire is growing. Adani has denied the allegations, and other banks continue to lend against its debt. Bloomberg understands the U.S. is to supply Ukraine with longer-range artillery and ammunition as part of a new $2 billion package of military assistance. The new aid, which is unlikely to include advanced weapons such as long-range missiles, comes as Kyiv prepares for a new Russian offensive. China's home sales continue to slump in January despite extra stimulus and the end of COVID-0. Data from a private provider suggests the 100 biggest real estate developers saw new home sales drop almost a third from a year earlier. The month was a key test of buyer demand, as many had their first chance in years to hunt for properties during the New Year holiday. Global news, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Alice Atkins, and this is Bloomberg. Francine.
Alice, thank you so much. Alice Atkins. In London, coming up, India is planning to boost its capital spending by 33% to a huge 10 trillion rupees. More on that next, and this is Bloomberg.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
Each year, 4 of the regional Fed bank presidents rotate out as voters and 4 new ones come in. Leaving this year, Jim Bullard of St. Louis, Esther George of Kansas City, Loretta Mester of Cleveland, and Boston's Susan Collins. All except Collins are considered somewhat hawkish. Coming in, the new president of the Chicago Fed, Austin Goolsbee, Philadelphia's Patrick Harker, and Dallas's Lori Logan, along with Minneapolis's Neil Kashkari. All except Kashkari are considered either dovish or somewhat centrist. There's little distance between the views of the hawks and doves on the Fed's Open Market Committee. 17 of the 19 members saw the Fed's target rate reaching over 5% by the end of this year, and none see rate cuts in 2023. The voters change, but the policy remains the same.
Well, that was Bloomberg's Mike McKee on who's in and who's out of the FOMC. Of course, it is Decision Day. We have a great Decision Day guide on our website. We'll push that out on our social media channels. And of course, the Federal Reserve likely pushing back against any suggestion that it will soon halt interest rate increases. That's at least the view of Jeffrey Gundlach of Double Line. We had a lot of time with him yesterday. Interesting to see how he sees traders positioning in terms of dollar until the end of the year. Now, the other big story, of course, is the budget in India. The Indian Prime Minister Narendra Modi has been commenting on the full year 2024 budget. This is what stocks are doing overall. Now, stocks in India rallied, and then they lost a little bit of ground. Look, higher government spending on roads, ports, and other infrastructure, while keeping the budget deficit under check, have been stoking optimism that measures will lead longer down the road to higher consumer spending and a boost of economic growth. Let me just remind you how much they're expecting capital spending to be by, and it's by more than a third to 10 trillion rupees. That's $122 billion. Now, Indian Finance Minister is planning, as we're saying, to increase capital spending by 33% in the upcoming fiscal year. Asia's third largest economy will invest in infrastructure in a bid to boost economic growth.
The world has recognized the Indian economy as a bright star. Our current year's economic growth is estimated to be at 7%. It is notable that this is the highest among all the major economies. This is in spite of the massive slowdown globally caused by COVID-19 and the war. The Indian economy is therefore on the right track, and despite a time of challenges, heading towards a bright future.
Well, joining us now is Menaka Doshi, Bloomberg's senior editor. Menaka, was the budget in line with expectations?
Yes, broadly, Francine, as you've pointed out, the budget sticks the course when it comes to fiscal consolidation. This is something that global investors were looking at, and the finance minister has delivered on that. So she has said that the fiscal deficit for this year will be 6.4% as expected, and it will reduce to 5.9% next year, again, as anticipated. So that's good news. What did come as a bit of a surprise was the enhanced spending on infrastructure. You ran through the numbers, so I won't repeat them. And that infrastructure spending is probably the first nod in the budget towards the upcoming election. It should help have a multiplier effect on the economy, create consumption, and create jobs. And it is spending on rural roads, on a variety of different other infrastructure projects, including construction and railways. So that's the second bit from the budget. Third, in the second nod to the upcoming election, and it's a big one for Prime Minister Modi, there have also been tweaks made to the personal income tax regime that will benefit the middle income taxpayer in India. So these are the three big takeaways from the budget.
Menaka, thanks so much. Menaka Doshi there for us on the very latest, of course, budget in India. That's it for the European Market Open. Surveillance Early Edition is up next. The big theme today, not only what the Fed, but what inflation will do overall. So let's look at the markets, gaining some 0.2%. 4 key questions that we need to look at, 4 key charts that we need to look at. Core inflation moderating. What does it mean for Powell going forward? Wage inflation also a little bit lower than expected. Financial conditions, and then we look at the terminal rate. So we have not only a full lineup of great guests talking about the Fed decision, we also talk dollar. This is Bloomberg.
very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Information you want, analysis you trust. Everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg. This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Slower gains in U.S. employment costs pave the way for a quarter-point hike by the Fed today. Bloomberg has learned Credit Suisse will not accept Adani bonds as collateral for margin loans. It comes as scrutiny for the Indian tycoon's empire grows. Plus, the UK's worst industrial action for a decade closes schools and cripples its rail network as 500,000 people strike over pay. Now, first thing is first, because it's Fed Day. What does Fed Day mean? It means that there's a decision day guide, and we look with a fine-tooth comb on what Jay Powell is looking at and what it could mean for future interest rate hikes. First of all, we look at wage inflation, financial conditions, we look at core inflation, and of course, we look at terminal rate and what that means. One of the questions that we need to ask ourselves is, if there's not a Fed pivot, how does Jay Powell convince the markets that he's not doing that? And what does it mean for dollar, but also for equities across the board? We're also getting some breaking news from PMI here in the Eurozone, 48.8. So it's pretty much, actually, it's exactly in line with what we were expecting. This is for the month of January. So a little bit backward looking. Anything below 50 indicates a contraction, and we are still in contraction territory, but at least there was no surprise to the downside. The other story, and again, thanks Aggie Cantrell for saying that Snap users are young and youthful, because we do have a couple in the newsroom of a certain vintage. Never mind, the Snap chief executive saying digital advertising slump has leveled off. Despite some of the encouraging signs that it will get better from here, investors picking this share price apart, down 16% in pre-market, and they're really worried about the first quarter of the revenue decline and what that means for the future. Now, the FOMC looks set to raise its benchmark rate by 25 basis points when it meets today, with Jay Powell keeping further hikes on the table. We're now joined by Trevor Greetham, head of multi-asset at Royal London Asset Management. Trevor, I also have no doubt you're on Snap, so we'll talk about your Snap account in a second. What are you expecting from the Fed? Do they still have to push back against too much optimism about a Fed pivot in the markets?
I think they do. I think they're very likely to shift down from 50 basis points to 25 basis points to reflect the fact that you are seeing some signs, mainly of headline inflation, coming lower. But at the same time, you've had such a loosening in financial market conditions in the last couple of months that I think what Powell's actually got to do is what I would describe as a hawkish downshift. He's got to sound tough. He's got to price out those rate cuts for later in the year.
Yeah.
but slow down the rate hikes.
Not difficult at all.
Not hard, no.
Especially as the markets just latch on to too much optimism. Does he push back against that today? And actually, how much of a headache are these financial conditions for him?
I think he does need to push back against it. I think what he'll say is that there's no rate cut in sight. So when people think of a pivot, they're thinking that the rate cuts are imminent. I think the message today will be they need to go higher. They haven't done yet. They've slowed down the pace of the rate hikes, and it's far too early to talk about the rate cuts, and that will be what he'll try to get across.
Do you think there'll be a Fed pivot? I mean, at some point, if they really continue hiking this much, there's going to be a downturn in the economy.
Absolutely, yeah. And it's funny because we're in this sort of, I would describe it as an interregnum between an interest rate-driven bear market and an earnings-driven bear market. We're in the gap in between, and the markets are melting up because they think they can see the end of the Fed rate hikes, but they can't yet see what's causing the Fed to stop hiking rates, and that is a recession. We're still expecting a recession, and when that comes, we think the Fed will end up pivoting, but the data's not there yet.
But is this a Fed orchestrated recession that's necessary? So are they doing this on purpose? Obviously not because they enjoy it, but because it's the only way to really slow inflation down.
I think they are, and it's worth remembering how we've been in such a disinflationary period for decades that we haven't seen one of these recessions. I mean, the last recession was a virus. The previous one was a financial crisis. You're back in 2000, where in some parts of the world, rather, there were no recessions. There was a tech wreck. You've got to go back to 1990, really, for the last central bank-created recession. And it takes a long time to get the economy to slow. And when it finally does slow, you've done too much tightening. And that's why when the Fed finally gets to the point where the economy rolls over, I think they'll end up cutting rates quicker than people think, but they can't give a sight to that yet.
So, Trevor, we have two charts, actually, that I wanted to bring up. First is the financial conditions, which is probably the money chart, right, that we'll spend a lot of time trying to dissect, or certainly Jay Powell. I don't know whether he looks at it on like a daily basis. Is that the Powell chart? Maybe. But then the market price of a terminal rate is also sub 5%. Is that wrong?
And it may not be wrong, but the market may need to believe in a 6% or even a 7% terminal rate before the economy responds. So we are seeing signs in the housing markets in particular of all the behaviors you would expect to see during monetary tightening. And housing markets all around the world are basically crashing. And that's usually a sign that about a year later you get a sharp downturn in the economy. But it may well be the Fed needs to keep going because weekly unemployment claims, for example, we're watching very closely, they're dropping in the US.
Yeah, but this is a chart, so this is a financial conditions chart. I do think we need to just spend a bit of time on that terminal rate chart. Is there a danger that we focus too much on terminal rate? It is coming, I'm promised the chart is coming, Trevor, so it'll come shortly, but the terminal rate changes almost all the time.
It does, and I think you've got to, the way I think about it anyway is if you've got to put yourself in the shoes of a central banker, they are not really focused on the terminal rate, they're focused on what they're doing at the next meeting. And they will keep hiking until they have really good confidence that the economy is slowing. And by that time, because of the lags of monetary policy, they will have done too much.
I was going to ask you about that. I mean, the problem is that you know, the Fed is data dependent, but if you're only data dependent, you're going to miss what you've done, especially if you've done 4 increases of 75 basis points, plus 150 in December.
Yeah, you're driving a car looking in the rearview mirror if you're the Fed, and that can cause accidents.
What does that mean for dollar?
Well, we've been underweight the dollar. We've done a few things to de-risk ahead of this Fed meeting. So we've reduced our dollar short positions. We've been buying dollars. We've actually sold some equity and some treasuries because we think that there will be this hawkish message this week, most likely. But the main point is that we are seeing the kind of melt-up you'd see in an economic recovery. We think that's premature. But there's nothing in the economy at the moment that says we're at that moment where the labour market's cracked. The labour markets are still really tight, and that means the Fed has to keep very consistent with a hawkish message, even if they are slowing down their rate hikes.
But are we too optimistic on even how market interprets earnings, so the rally that we saw in equities?
I think we are. I mean, the only asset class I can look at that I think has having a go at pricing in the recessions is UK commercial property, which fell into a tailspin because of the mini budget. It's down about 20% year on year. If you look at bond yields in a recession, they would be low, not high. If you look at credit spreads, they'd be wide, not tight. If you look at stocks, they'd be underperforming bonds, not outperforming bonds. So it still feels like there's another shoe to drop later in the year. But it could be the second half of the year that this really happens. We don't know. In the meantime, we are actually overweight equities.
Trevor thinks
nervously.
Nervously overweight. I like that. I'm always
I don't think we're alone.
nervous.
Lots of people are nervously overweight equities at the moment.
I love that, nervously overweight equities. Trevor, thank you so much. Trevor Greetham, head of multi-asset at Royal London Asset Management, joining us this morning. Coming up, we're also joined by Catherine Ashton, the former EU High Secretary for Foreign Affairs and Security. We'll discuss her new book and get her views on the current state of global affairs. So stick around for that interview a little bit later on in the show. This is Bloomberg.
No one can claim that climate change is somebody else's problem or shrug it off for future generations to address. We're all affected by a warming planet. We see that every day. And decisions being made right now will determine our shared tomorrow. So we must choose, and we must act as united nations ourselves. Our progress depends on collective action, on collective ingenuity. If we stick together, we can make fixing the climate the greatest project and greatest achievement of our lifetimes. We have the science, we have the solutions. Now all the world needs is political will. Together, we can create a future where rampant carbon is removed from the atmosphere, where green buildings and green business transform the livability of communities.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gearns. Hi, Leanne.
Hi, Francine. Bloomberg has learned the private banking unit of Credit Suisse has stopped accepting Adani bonds as collateral for margin loans. Credit Suisse was listed as a backer in Adani's rebuttal of the Hindenburg research fraud allegations earlier this week. The move is another sign that a scrutiny of the Indian tycoon's empire is indeed growing. Adani has denied the allegations and other banks continue to lend against its debt. Now, Bloomberg understands the US is to supply Ukraine with longer-range artillery and ammunition as part of a new $2 billion package of military assistance. The new aid, which is unlikely to include advanced weapons such as long-range missiles, comes as Kyiv prepares for a new Russian offensive. And when a Porsche dealership over in China posted an online advert for the latest Panamera, it wasn't the car's sleek curves that did grab the most attention. Drivers thought their luck was in when they saw the price tag, just $18,000, rather than the usual price of $150,000. Sadly, for the hundreds of eagle-eyed customers who put down a reservation fee, the car just didn't get delivered. Global news, 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gearns. This is Bloomberg. Francine.
I thought they had to honor the price, even if it's for 10 £10. You have laws. It has to be honored.
Yeah, well, one person actually benefited from the gaffe. So the first person who put down the reservation fee, Francine, did broker a deal with Porsche. So we don't know how much he got the car for in the end. Or possibly she, because all of us like Porsches.
Yeah, I mean, we like fast cars,
Yes.
especially in red. I don't know. If you don't buy a fast car in a red color, then Leanne and I will not speak to you. Leanne, thank you so much. Coming up, we're joined by the chief executive of Novo Nordisk as the pharma company forecasts record profit in 2023. Don't miss that interview next. This is Bloomberg.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
The UK expects significant disruption today as 500,000 workers walk out of their jobs in disputes over pay. Well, Bloomberg's Tom McKenzie joins us from London's King's Cross rail station. Tom, good morning. So what can UK residents expect today? Total chaos?
Well, it's certainly going to be a major impact. Look, the context is this is the most severe industrial action, the most severe strike action for the UK, and the UK has seen for about a decade. And as you nodded to there, 500,000 have the mandate to strike. But this is across schools, it's across railways, ports as well, because civil servants, about 100,000 civil servants could be walking out of the job as well. So you look at airports, disruption there is expected, ports as well, because the border force, many members there will be striking today. And then, of course, across the education system, schools, about 85% of schools could be closed entirely or partially closed. That's according to the union, the National Education Union. Now, the Education Minister has come out and said in the last few hours that actually the majority of schools will remain open, but still the impact, of course, on families and workers is there. And when it comes to the railways. We are here at one of the key hubs, of course, King's Cross Station here in London. We've heard that around 20% of services will be running, so 80% not running. Why is this all happening today? It's the ramp up after, of course, more than 6 months of industrial action across the UK. The focus is on the pain point for workers. That's what the unions say around the cost of living crisis. They want these wage increases. On average, public sector workers have received increases of about 3%. Inflation, of course, here in the UK running at 10.5%, Francine.
So, Tom, why has an agreement between the government and the unions just proven so difficult?
So the government's line is this: inflation is such an issue. If you were to meet these wage demands, double-digit wage demands that are coming through from everyone from the railway workers to teachers to nurses, then you're just going to entrench inflation in this economy and make it that much more painful for everyone else. The unions, of course, push back on that. And we spoke to the Assistant General Secretary of the TUC, the Trade Unions Congress, earlier, and she said, look, there is no evidence of a wage price spiral. They simply reject that idea outright. In terms of the movement on discussions, you have had a little bit of movement when it comes to railways. One of those unions, TSSA, they have put forward a proposal from 14 operators to some of their members. So the needle has moved in that direction positively. But for the rest of these unions, they are saying that they are just getting an entrenched response from government ministers. There hasn't been any major movement. And in terms of ASLEF, which is another major railway union, representing drivers, they said, in fact, the situation is worse than it was 6 months ago. So it seems like the government largely is digging in, the unions hoping that today's action will lead to further conversations. They will get some kind of progress on these wage demands.
So, Tom, on a separate note, UK Chancellor Jeremy Hunt is also being urged by Tory MPs to lower taxes. How likely is this?
Well, it's pretty unlikely if you take the Chancellor at his word. He gave that speech at the Bloomberg headquarters, of course, on Friday, and then he reiterated that to these backbench Tory MPs at the 1922 committee on Tuesday. But yes, the pressure is there. Look, the IMF came out with this pretty dire report and forecast on the trajectory for the UK economy. Pretty grim reading for many. And these Tory MPs then, at least a number of them, are increasingly pressuring the Chancellor, saying we have to have tax cuts in that March budget. The Chancellor says the priority is inflation. They don't have the fiscal headroom to cut taxes, at least for now. If it does come through taxes later on, once inflation is heading down, it will be focused on business rates. Francine.
Thank you so much, Tom Mackenzie, of course, my co-anchor at King's Cross Station. Now, Danish drug maker Novo Nordisk says earnings will rise this year to record levels, boosted by soaring demand for its Wegovy obesity drug. Now, we're now joined by President and Chief Executive Officer of Novo Nordisk, Lars Fruergaard Jørgensen. Lars, as always, thank you so much for joining us. How much are you expecting this drug to increase demand, or how much demand for this drug are you expecting to be increased in the next 5 to 10 years?
Well, we expect this will be a very, very significant part of our business. We are just getting going on obesity. We know there are many more people living with obesity than there are people living with diabetes. And it's basically a complete new market. We are now launching Wegovy again in the US. We have launched in Denmark and Norway, and we look to gradually roll out in more countries during this year. So a very, very significant opportunity for Novo Nordisk.
When are you expecting to start selling Wegovy in the UK?
Well, I cannot disclose that. UK is one of the countries we are looking at. UK is also one of the countries where there's the biggest population of people living with obesity, so it's an obvious market for us to focus on. And we all know that obesity is a leading cause of other diseases like type 2 diabetes, cardiovascular disease, some cancers. So it's really important not only for the individual, but also for the health resilience and also for our healthcare systems that are increasingly struggling in coping with the diseases that follows an aging population.
Yeah. But Lars, I understand that you've delayed the introduction of this drug in Europe because you wanted to make sure that there was enough, of the supply chain bottlenecks being dealt with in the US. Is that still the case? How do you see the rollout going?
We have now replenished our inventories. We have manufacturing running. We have all doses available in the US from the end of 2022. So we're now back in the market, and we see a very strong uptake. We see that the number of new scripts are now already a couple of weeks in higher than what we have seen any time before. So it's a very strong and very encouraging signal of the launch, and we will have additional manufacturing lines coming online during this year.
Yeah.
So we believe we have robust supply.
Is the U.S. still a more attractive market to launch drugs because they don't have so much price regulations?
Well, in the US, you get relative quick approval by the FDA compared to Europe. That takes longer time. And then in the US, you can secure market access by negotiating with the pharmacy benefit managers relative fast compared to Europe, where you have to go country by country and gain access. So in that sense, US is a more attractive market. You can get earlier to market, and there is more of a pull nature from, say, commercial insurance compared to Europe, where it's a slower process. Nevertheless, we are also rolling out in Europe, and we see the same health benefits from our medicines in Europe. And we also see the same pull demand from patients living with obesity in Europe. So we are equally excited about it, but it takes a bit longer time because of the way the market is structured.
And how well are things going in the U.S. to get health insurers to cover some of these new obesity drugs?
It's going very well. All the large pharmacy benefit managers has adopted it on formulary, and in the US, employers have to opt in. So we actually see now that we have an addressable market that's similar to the market we have in diabetes. In the US, 109 million Americans live with a BMI above 30. So it's a very, very sizable market, and we already now have an addressable market that's similar to what we have in diabetes. So it's a significant opportunity, and we are ready to go and take our share of that market.
What about Europe? Are European governments being too difficult with reimbursements or too stingy on drug prices?
So it's interesting to note that the first two markets we've launched in Denmark and in Norway, it's actually out-of-pocket pay, so there's not yet reimbursement. Yet we see a very strong uptake, stronger than what we have typically seen when we launch a diabetes product. So this tells about the struggles people with obesity have been living with for long, tried many different types of interventions, often not succeeding. So when there is a medicine available, there's actually willingness to pay out of pocket. In parallel, we're building the case with the healthcare systems for government reimbursement. And we also make some progress there, but it takes time in Europe because you have to negotiate country by country.
Lars, thank you so much for joining us today. Lars Fruergaard Jørgensen, the President and Chief Executive of Novo Nordisk. We're also getting some breaking news of Adani Enterprises. Those shares are actually extending losses to 25%. So they were down 10% and then they were halted. But I have to say the crisis of confidence plaguing Adani is deepening, with the stock rout triggered by, of course, the fraud allegation, erasing a third of the market value in the group's companies despite the completion of a key share sale. We'll have plenty more on that shortly. This is Bloomberg. Amazon acquired Zoox back in January 2020 for what reports suggested was $1.2 billion. Since then, the company has revealed its Zoox vehicle. This is, I think, a rectangular passenger-focused vehicle with no driver's seat or steering wheel. How would you describe it?
we describe it as a purpose-built vehicle, but it's really a robo-taxi. That's its purpose. And essentially, it's about transporting people from point A to point B on demand in the most effective, cleanest, and most enjoyable way.
So why won't you call it a car?
Because a car is, there's an inference that there is a driver. Whereas in our robotaxi, there is no manual driving. A human cannot really drive it to transport passengers. So we want to make sure that that mindset, that shift, that distinction is clear.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America. BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Slower gains in U.S. employment costs paved the way for a quarter-point hike by the Fed today. Bloomberg has learned Credit Suisse will not accept Adani bonds as collateral for margin loans. It comes as scrutiny of the Indian tycoon's empire grows. Adani Enterprises plunge 25%. Plus, the UK's worst industrial action for a decade closes schools and cripples its rail network as 500,000 people strike over pay. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. So India's government has proposed boosting capital spending by more than a third to 10 trillion rupees, that's $122 billion, to pay for infrastructure projects. Now, when delivering her budget, India's finance minister said the country's economy was in good shape.
The world has recognized the Indian economy as a bright star. Our current year's economic growth is estimated to be at 7%. It is notable that this is the highest among all the major economies. This is in spite of the massive slowdown globally caused by COVID-19 and the war. The Indian economy is therefore on the right track, and despite a time of challenges, heading towards a bright future.
Joining us now is Menaka Doshi, Bloomberg senior editor for India. Menaka, thank you for joining us. Is the budget, unexpected lines?
Yes and no, Francine. You pointed out that there is an enhanced expenditure or outlay towards infrastructure. I'll get to that in just a bit. But what was expected and what has been delivered by the finance minister is a fiscally conservative budget that sticks to the path of a declining fiscal deficit from roughly 6.4% of GDP this year to 5.9%. And that would make global investors very happy. The borrowing program to fill that deficit has also come in a bit lower than expected. So that's good news for both the equity and bond markets. Now, what's also good news is in a nod to the upcoming national election next year, the government has done two things in this budget. One, raise the infrastructure spend quite substantially, as you've pointed out, and that's money that will go towards rural roads, ports, construction, affordable housing. And the second thing is tax perks for middle-class taxpayers, and that surely will will help them when it comes to votes being cast next year, because that will be a welcome move. So these are the three key takeaways from the budget today.
So, Menaka, basically what they're trying to do through all of the spending in infrastructure, and I have to say a third higher is something that is pretty incredible to see, especially on that scale, is that this will also help then boost consumer confidence going forward.
Well, absolutely. I think this is the third year that we've seen such a significant increase in infrastructure spending, and there are two reasons for this. Private investment in India has not picked up as anticipated after the COVID recovery, and so the government's trying to rush in private investment, if it can, by putting in its own money to work. So that's one effort. And secondly, it will help consumption, which is the need of the hour, and it should hopefully generate jobs, again the need of the hour, in an ordinary year, but definitely in a year before a big election.
Yeah, I think, Manaka, looking at stocks, I mean, stocks rose, bonds were declining on the spending plans. I mean, it's pretty incredible to think that that economy, your economy, is on track to expand around 7% in the fiscal 2023. Talk to me a little bit about Adani. I don't know how it's being lived through in India and the potential fallout that could come from there.
Well, we did hear some noise in Parliament today, opposition leaders trying to make a point on the Adani issue, which has played out quite dramatically over the last week or so here in the Indian markets and in the corporate landscape. Francine, I don't have a clear answer to give you, because as you're watching your screen, you're probably seeing those stocks in free fall, and that's been the case over the last couple of hours here in India. The Indian markets reacted reasonably positively to the budget, but Adani and some other stocks are pulling it down, and it looks like the fallout from that fight with Hindenburg, a US-based short seller, is yet to finish playing out. The allegations continue, and the short selling seems to continue as well.
Yeah, it's something, pretty incredible to behold, actually. I know we'll talk a lot more about the story. Manaka, thank you so much for joining us, Manaka Doshi. Now, as promised, we're getting some figures out of the UK. This is on the worst UK strikes day in over a decade. A lot of the trains, I think almost all of the trains, have stopped working, and many schools are closed. UK January, in that context, UK January manufacturing, PMI coming in at 47. Anything below 50 is, of course, a contraction, a touch better than expected, because we were expecting a 46.7 figure, coming in at 47. Now, Bloomberg understands that Credit Suisse has stopped accepting bonds of Adani's group of companies as collateral for margin loans to its private banking clients. Scrutiny of the Indian tycoon's finances is growing after allegations of this fraud by short seller Hindenburg, which the Adani Group denies. Well, shares extend the losses. Let's bring in Bloomberg's Tom Metcalf. So, Tom, first of all, good morning. Thanks so much for joining us. The stock was down 10%. It got halted. It's now down 25%. Is this because Credit Suisse said, actually, we're not going to touch it anymore?
Yeah, it's a huge drop, right? I've just seen it, 29%. I'm like, wow, that's huge value destruction. I think Credit Suisse is part of this. It's all a sentiment-driven story, right? Like, if they can get back that confidence, perhaps the situation could reverse, at least in part. But yeah, it's exactly the kind of news that Adani does not want, because it suggests that certainly some investors, some lenders are still very wary, despite a very big share sale yesterday. And you can see that in the share price, and that is absolutely huge, that drop.
So what do we know about the Credit Suisse decision? This is basically, first of all, explains how this collateral works. Yeah. And is it because they have no confidence in Adani, or they just don't want to touch it right now?
Yeah, I can get some pretty niche finance in here. So this is Credit Suisse's private bank, and effectively this is in relation to margin loans. So previously, before this sort of saga started, Credit Suisse, if you owed them money, they might, obviously loan you money and take collateral against that. And they would sometimes say, okay, we'll take your Adani shares and we'll value them at 75% on the dollar, 75 cents on the dollar. Now they're saying, we're not going to take them as collateral at all, i.e. they effectively say that there's no value, at least in their kind of risk perspective. So that's a big change, and it's, so far as we understand it, Credit Suisse is the only one that's been reported to be doing this, but obviously, bankers are a bit like sheep, maybe others follow, and certainly sentiment-wise, this is not a good look. This is a big bank with a lot of rich customers saying, we don't actually want to have this on our books.
Do we understand how interlinked with global finance Adani groups actually are?
Yeah, well, that share price is a real problem, because basically credit, all the kind of bonds off this are all in some ways going to be linked to this. So, for example, at Credit Suisse, let's say they were accepting collateral, that big drop in the share price might well require them to be like, oh, well, those shares are worth less, we need more of them, or we need other collateral. So it's all follows kind of the stock market and the sentiment. And what Adani really needs to happen is that stock price to stabilize, they restore it, inject a bit more confidence, and then this sort of doom loop, as some might say, would hopefully stop.
Tom, thank you so much. Tom Metcalf there with the very latest on Credit Suisse and Adani. Now, coming up, she's one of the UK's most distinguished diplomats. Catherine Ashton will join us to discuss her new book, and we'll get her views on the current state of global affairs. That interview is next, and this is Bloomberg.
Make it very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them, and so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value, and the kind of transparency that they want.
Are you seeing a labor shortage right now, and what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing, where 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
Why is it that whenever there is like a scare coming along or a pandemic or something, people rush to buy toilet paper? You ever notice that? People are just, they're stockpiling toilet paper.
It's
Is that
called hoarding, and
okay.
it's one of those things you never want to be without.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Catherine Ashton had a front row seat to one of the most turbulent periods of history in recent memory. As the EU's first High Representative for Foreign Affairs and Security, Ashton faced the challenge of representing the bloc through events including Russia's invasion of Crimea, nuclear negotiations with Iran. That and much more is detailed in her new book, And Then What? Well, Catherine Ashton, Baroness Ashton, welcome to Bloomberg. We also, I was lucky enough to listen to you speak to talk about the book and some of the extraordinary things that you've seen in diplomacy. So thank you so much for joining us. Has the language of diplomacy and the way we speak to each other changed?
I think the important thing about diplomacy is always to remember that so much of it goes on under the radar. You know, it doesn't even appear on Bloomberg. It's done in back rooms and in discussions that are drip, 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 drip over days, weeks, months, and years. So the language of diplomacy is almost kind of hidden. We talk a lot about diplomatic behavior and diplomatic words, and there is an important element to making sure that what we talk about is done wisely and well. And in the days of Twitter and so on, it's harder to kind of remember that. So it's important to keep that language solid and clear.
It's pretty incredible, and it is really a remarkable book, very well written, very detailed. But it also gives us a glimpse of some of the actors that we're facing today: geopolitics, Vladimir Putin, Mr. Lavrov. What's the right way at the moment, given the heightened geopolitical risks, to deal with foreign policy?
So we know quite a lot about the toolkit we need, the diplomatic toolkit. We have a combination of trying to develop strong relationships with countries and with leaders, right the way through to putting them in the freezer and actually just having nothing to do with them. And somewhere in between that is usually where we are with countries with whom we're trying to make progress, but who are, frankly, behaving extremely badly, creating havoc and chaos, either for their own people or outside, or both. And we're constantly trying to move forward. So in foreign policy terms, one of the things we have to think about is, do we have enough tools? Sanctions we use a lot. We tend to treat them as if they were the end and not the means to the end. But I think we need to think about what else we can do and what we can do together.
Why did you call it "and then what"? This is also a leadership style.
So in my office, when I used to talk to these amazing diplomats and officials from all over Europe, we had the brightest and the best. We would talk about what to do about a particular problem, an issue, whether what was going on in the Arab Spring or what was happening in Ukraine in those early days, or how to develop the Iran talks. I would always try and say, and then what? Because we always had to think beyond the immediate. And one of the big issues, I think, is we tend to think short term. Big problems come along, often they take decades to appear, and we kind of think 6 months will solve it. It's not like that.
Should we have handled Crimea differently? And you talk about this in the book. Actually, you had a front row seat of what was happening with Vladimir Putin.
I think there was a sense that we allowed it to freeze where it was. That when, in 2014, Russia took Crimea and moved into the Donbass, for the ensuing years until the invasion, it all got stuck. There was very little progress made. Yes, there was a Minsk agreement. Both sides say the other was never going to implement that. And I was in Ukraine just before we all went into lockdown. And there was a real sense there that they were kind of on their own again. Not that we weren't with them, but nothing was happening, and that strength of help and support. So, yes, you're right that we probably should have moved forward. But again, back to the toolkit. What would we have used? How would we have done that?
What would you have done differently to what our current leadership are doing with Ukraine?
I think the current leadership are really trying hard to offer the maximum possible support to Ukraine, and that's right and proper. We want to see Ukraine as a whole nation, free and able to determine its own future democratically and peacefully. Absolutely, that has to be the objective. The only thing I would say is, as we look at what we're doing now and supplying rightly the weaponry that they need, I still would ask the "and then what" question. I still would say sometime down the track, whether this goes on for months or years, we have got to work out what happens next and what's going to be the security of Europe and the relationship with Russia in 10 or 20 years' time.
So should someone maybe from the U.S. administration had flown to China on that 24th of February of last year?
Well, I often say that one of the things that you do in any conflict is look at who's working with who and how to kind of put a wedge yourself in between. And I think China is an important player in this. And I think we're all still working out what the strategic approach to China is. I think economically and politically it's very different. But I don't really think that there's a strategy anywhere, and I think that needs to happen. So I think it's very important to keep talking to China in this context, as well as lots of other countries, because it is those other nations, that kind of alliance that comes together, that may not fully support everything that you're doing, but are willing to work with you on trying to solve this particular problem.
But Catherine Ashton, 2023, are you worried about the direction we're taking? It feels like the world is split and fractured in ways that maybe we didn't even realize 2 years ago.
I call it tankers and yachts. Tankers are the big organizations like the UN, like the EU. They're big tankers, they're at sea, they're hard to maneuver, but they keep going. And we must not let them rust. We have to make sure that they keep being resupplied, because they're based on values and ideals and ideas. And yes, they get battered and beaten, but they're still there. And then the yachts are these coalitions, these groups that come together around a particular crisis. They move, they zip across the water, they're able to do things, but they don't have the weight and they can't remain at sea too long. So all I would say is we need to look after our tankers right now and make sure that we don't forget the reason that they exist and the importance of making sure those coalitions, strength together, actually continue to function.
What have you learned about the way that, I guess, female leaders do diplomacy compared to men? Are there any differences?
I always say the best team, when you're doing diplomacy or negotiation, is men and women together, because we have different experiences and different backgrounds as individuals as well as men and women. And that's true, economically, politically, no nation can be the best it possibly can be unless it's using the goodwill and the expertise of all of its people. Well, that's true in diplomacy as it is everywhere else. So women leaders, in my experience, tend to think slightly differently. They tend to, I would say, look at the and then what questions a bit more. That may be just the nature of the way our lives have panned out and the expectations on us. But it's important to have that balance between men and women. It's a fabulous coalition when it works.
You talk in the book also with great humor about what, when you arrive in Brussels for the first time. What kind of relation? What did you learn about Brussels and the Commission back then that maybe some of the UK government should be reminded of?
One of the great things about working with the 27, then 28 countries when Croatia joined, and the commissioners that came with that, was that you had all of this knowledge and expertise that just amplified everything that you wanted to do. Round the table, when I chaired the Foreign Affairs Council, there was always a country or a minister who knew about whatever the problem was or the issue was. And they also came with their own priorities and engaged others in pursuing those priorities. And that was certainly true for the UK. And it was really important. So it is important to always remember that the value of being able to work together. And in Brussels, that's what you see. It is also the only place where to be an ambassador and to fail to reach agreement is a negative. You're not just there representing your own country. Your job is to find solutions.
Do you think, and I hear this, but I don't know whether you believe Brussels misses the Brits in negotiations?
I'm sure it does. I'm sure it does. I mean, there we were. We could be incredibly awkward. I was a minister representing the UK government in committees, and we were just as difficult as any other government from the UK. But we were there in a constructive spirit too, and they really looked to the Brits to be the kind of oil sometimes to help things move along. And there was a lot of British interest and recognition of the role of the Eastern European countries that had come in from the former Soviet Union, the importance that they played, and a real determination to make sure that their voices were heard as well. So I think they do miss us.
Catherine Ashton, thank you so much. Well, it's a great book and actually really also great conversation. So thank you so much for coming on. Catherine Ashton, they're the former EU High Representative for Foreign Affairs and Security. Coming up, as the Fed meets for the first time this year, we also take a look at who's in and who's out on the voting committee. That's next, and this is Bloomberg.
No one can claim that climate change is somebody else's problem or shrug it off for future generations to address. We're all affected by a warming planet. We see that every day. And decisions being made right now will determine our shared tomorrow. So we must choose, and we must act as United Nations ourselves. Our progress depends on collective action, on collective ingenuity. If we stick together, we can make fixing the climate the greatest project and greatest achievement of our lifetimes. We have the science, we have the solutions. Now all the world needs is political will. Together, we can create a future where rampant carbon is removed from the atmosphere, where green buildings and green business transform the livability of communities.
The top names in business are on Bloomberg.
More and more people are frightened of the realities of today, and that's manifesting in so many areas. Why would anybody put something into a 30-year obligation unless you believe something is better in 30 years? I'm not here to suggest it's going to be rosy in 2023, but what I'm saying for long-term investing, it's a better environment for long-term investing today than it was 2 years ago.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Widespread industrial action will close schools and cripple Britain's rail network today. Close to 500,000 union members are set to strike, demanding pay rises to catch up with soaring inflation. A walkout by teachers will see most schools shut or partly shut, with several major train stations in London also completely closed. Now, China's home sales continued to slump in January despite extra stimulus and the end of COVID-0. Data from a private provider suggested the 100 biggest real estate developers saw new home sales drop almost a third from a year earlier. The month was a key test of buyer demand, as many had their first chance in years to hunt for properties during the New Year holiday. Boeing CEO says it's a matter of when, not if, self-flying planes will debut in commercial aviation. In an exclusive interview, David Calhoun told us autonomous flight technology being developed for the military will eventually be used commercially. The conversation was timed to coincide with the delivery of Boeing's final 747 jumbo jet, 54 years after production did begin.
As you may know, we have an application on an all-electric autonomous airplane. We refer to as WISC. And that airplane, that application is in, and the FAA will begin working with us today on building out a certification program for autonomy and for WISC.
And Bloomberg has learned last week's system glitch resulting in wild stock swings on the New York Stock Exchange is triggering thousands of damage claims. Sources say the likes of Charles Schwab, Robinhood and Citadel Securities have submitted a request. We're told the claims are likely to exceed the $500,000 the exchange does set aside each month to cover disruption. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Thank you so much, Leanne. Now, this is a picture across the board. Adani Enterprises down 10%. They were halted, then down 25%, still extending losses. So we have to spend a bit of time looking at the Adani round, passing some $90 billion. I have to say the crisis of confidence plaguing Adani is deepening. The stock rout that was triggered by the fraud allegations, erasing a third of the market value in the companies despite the completion of a key share sale. So we'll have a look, of course, at that throughout the day. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Kaylee Lyons in New York, are Anna Edwards here in London, and this is Bloomberg.
What about cryptocurrencies? Are you a believer in cryptocurrencies?
No, I'm not a believer in cryptocurrencies, and I would say that cryptocurrencies are a bubble. And I would describe cryptocurrencies as a limited supply of nothing. So to the extent there's more demand than the limited supply, the price would go up. But to the extent the demand falls, then the price would go down. There's no intrinsic value to any of the cryptocurrencies, except that there's a limited amount.
Well, based on what you've just said, why would you not put a big short of some type on cryptocurrencies? Or maybe you have, but do you think that's a good short?
Well, you know, when we look for these subprime, the reason why we shorted the subprime in size because it was asymmetrical. You're shorting a bond at par that has a limited duration that trades at a 1% spread of treasury, so you can't lose more than the spread in the duration. Yet if it defaults, you can make the par amount. In crypto, there's unlimited downside. So even though I could be right over the long term, in the short term, as the case of Bitcoin, you know, went from 5,000 to 45,000, you know, I would be wiped out on the short side. So it's just too volatile to short.
The moment news breaks, no one covers the world like Bloomberg.
The return to pragmatism is really that everybody's in line. The government, the enterprises, the people, in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt, with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority. From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
What the Fed does matters, and it matters a lot for the global economy.
The Fed wants to see real yields higher, really to make sure inflation is down and stays down for a while.
The Fed is hawkish, but they're sort of reiterating a message that the market's already kind of gotten comfortable with.
We're getting close to that end game as far as the Fed tightening cycle is concerned.
This is Bloomberg Surveillance, early edition, with Anna Edwards, Matt Miller, and Kayleigh Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. The Fed's set to slow down interest rate hikes again, but policymakers are likely to hammer home the message that their work isn't done yet. It's the UK's worst day of strikes in more than a decade. Hundreds of thousands of workers are staying off the job, demanding bigger pay hikes to offset inflation. And more signs of how big tech is doing. Earnings from Snap disappoint. Next up, Facebook parents Meta platforms. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kayleigh Lines in New York. And Kayleigh, markets here in Europe can do what markets want to do this morning, but all we are really focused on is the Fed later on today.
Absolutely, and not even so much the decision, Anna, because 25 basis points is baked in. It's going to be all about the press conference and the tone Chairman Powell strikes, how hawkish his message is. So really, we're all just waiting and watching to hear from him. And of course, markets in Asia had to trade prior to all of that. And it broadly was an up day in Asia. The MSCI Asia Pacific Index higher by about 0.75%. Some outperformance coming from Chinese technology stocks after 2 days of losses. The Hang Seng Index, tech index up by about 3.4%. But really, the stock stories to watch are in India, the Adani Group companies that are under continued pressure, including the flagship Adani Enterprises, down as much as 30% on an intraday basis, now down just about 27%. But now collectively among these 10 groups in the conglomerate, or 10 companies in the conglomerate, we have seen $93 billion in value wiped off of these shares since that Hindenburg report came out. Clearly the completion of that share sale yesterday not doing much to restore confidence, because this is an absolute wipeout that is ongoing. Finally, in the bond market as well, just wanted to point to New Zealand. The 2-year yield dropped about 7 basis points to 4.43 or so after a weaker than expected jobs report. That is leading to some cooling in hike bets from the central bank this month. Now just 50 basis points is expected rather than 75. But of course, that still larger than what we expect from the Fed today, Matt.
I got to say, I can't take my eye off the Adani Enterprises slide today. It's pretty unbelievable to watch after the share sale was completed, especially considering the Credit Suisse story that we're going to delve into in a little bit. Take a look at S&P futures, down 1/3%. Pretty substantial move for a Fed day, right? Because we typically see very little movement on a day like this. As Kayleigh said, 25 basis points is baked in, but we do expect really hawkish language from Jerome Powell because financial conditions have loosened so much even as the Fed continues to hike rates. The 10-year yield right now down about 4 basis points, so investors are buying this debt. Why would you buy debt if you expect the Fed to hike? You can get a bigger coupon in just a few hours when the next auction comes out. But it does look like investors are bringing the yield down now to 347, 346.99 to go out 5 significant digits. We did see crude float back up. This is West Texas Intermediate yesterday, but it's off again now, just 2 cents a barrel, but it's 78.87. It's a couple dollars higher than it was at the same time yesterday. And then Bitcoin, still at 23,000. I'm gonna leave Bitcoin out until we get some movement away from this number because we've been here for a couple of weeks now, 22,991, and it's just not showing a lot of volatility once again. Anna, what do you see in terms of European markets this morning?
Matt, I'm sure last time you said that about Bitcoin. We then got some movement, so stay tuned for that. Well, this looks more as you would expect for a Fed day, I suppose. A lot of grey across the screen here for European markets. We're kind of standing still, waiting to hear what the Fed has to say. To what extent do we get that hawkish pushback and that objection to how loose financial conditions are? So this is where we are on European equity markets, actually giving up some earlier gains, which we had seen here, catching up with Wall Street, essentially. So that's the picture across European equity markets. One sector in focus is travel and leisure, up by 1.2%. It's the leisure side, the gaming and the gambling side that seems to be to the fore. Travel stocks also not doing too bad, the likes of TUI trading a little higher, but Entain out with some numbers that pleased investors, and that's a betting business, and so that sector going higher. Vodafone, on the other hand, down by 1.9%. This business, of course, lost its CEO, the interim CEO saying, well, they could do better. Also pretty down on Europe and what Europe could deliver over the past quarter or so. They have effectively sold their Hungarian business, though, on European news. Novartis also down on Europe, though, for a different reason. This is the drugs maker based in Switzerland, down by 1.4% on the day they released earnings, but also an interesting conversation with the CEO earlier on about how he sees that maybe Europe doesn't have quite the right climate for innovation when it comes to new drugs as he would like to see. And here's the euro, 108.84. Not a great deal of movement on this latest CPI print. The euro area January consumer prices rising by 8.5% year on year against an estimate of 8.9%. But of course, we already think we know what we're going to see from the ECB this week. We expect, Matt, to get the Fed to hike by 25 basis points and then the ECB to do 50. We'll be watching Eurodollar to see how it responds, Matt.
Yeah, the Fed expected to slow down. The February FOMC meeting is here. Another downshift in the pace of rate hikes, as we've been talking about, to 25 basis points is widely expected. But for markets, it's all about Jerome Powell's opening statement and tone in the new conference, in the news conference, I should say. Jeremy Stretch, head of G10 FX strategy at CIBC, weighed in.
Clearly, he's going to try and walk the tightrope of saying that the Fed are getting nearer the inflection point in terms of policy adjustment, but we're not there yet. But more importantly, he would try and push back against that market pricing for rate cuts in the second half of this year.
Joining us for a look ahead, I should say, is Bloomberg's Valerie Teitel. So it seems like they're going to step down again, even, Valerie, as financial conditions loosen up to the most in a year.
All right, Matt, yes, but the key focus will be on this statement in the opening statement. What is he going to do with this line, ongoing increases are needed in the target rate? Does that line stay there, or is it perhaps amended? Does it perhaps show some evolution that the Fed funds rate is now approaching the peak rate, or could it be dropped entirely? If it is dropped entirely, a lot of the market does expect some sort of pushback on those rate cuts that you mentioned. Perhaps he adds a line in here that gives some extended forward guidance that they plan to keep rates sufficiently restrictive. But for the hawkish and dovish hits, it's all going to be about his assessment of the moderation of inflation. For a hawkish hit, he's going to have to keep the hope that a May hike is still alive. He'd do this by almost dismissing the recent drop of inflation, saying he almost doesn't believe it because the unemployment rate hasn't ticked higher. The labor market is still strong, which means inflation is unlikely to fall back to 2%. And he could repeat that the Fed has a way to go. But if it's a dovish hit, he'd definitely have to leave the door open for the Fed to pause in March. He could do this by acknowledging that inflation, that the trend downwards is welcome, and that rates are already approaching sufficiently restrictive, and he'd declare that we are data dependent, not necessarily declaring victory on inflation yet, Matt, but that would open the door to the market to believe that a pause in March is on the cards.
All right, Valerie Teitel, thank you so much. And of course, we're also going to get some economic data today, including ISM manufacturing and JOLTS before Powell takes the podium. Our special coverage begins at 1:30 p.m. New York time, 6:30 p.m. in London for the Fed Decides. Meanwhile, the UK has been hit by its most severe day of strikes in more than a decade. As many as 475,000 union members are on strike today, closing schools and crippling the nation's rail network. Bloomberg spoke with the General Secretary of the National Education Union.
No price has to go up because a teacher gets a pay rise. There's no direct impact on inflation. There are no prices linked to teacher salaries. And we don't accept that argument.
Bloomberg's Tom McKenzie has been following the picket lines around central London. Tom, where are you now, and what can residents in the UK expect today?
Kelly, yeah, I'm outside Euston Station. You can see the picket line of railway workers and drivers, the ASLEF union here, picketing outside a major transport hub, of course, in the UK capital. Look, the disruption is going to be significant. As you say, this is really the biggest coordinated strike action we've seen in the UK for a decade. As well as the train drivers are striking and the crippling then of the railway network, about 20% of the service only, 80% is going to be shut down across UK railways. You're also getting the civil service for the first time striking today as well. That's about 100,000 people. So that leads to disruption, particularly at airports and ports, because Border Force is part of that mix. Layered on top of that are the teachers, the teaching union, one of the major ones, and you heard there from one of the Secretary Generals, or at least the Assistant General Secretary of the National Education Union, they are also striking. So thousands of schools are expected to be closed. Around 85% of schools will be either partially closed or completely closed. Again, according to the union, the Education Minister pushed back on that number a little bit this morning, but the disruption is going to be significant. And with those teacher strikes, it really brings it into people's homes. Why are they doing this? You heard about the pushback on inflation there in terms of the union saying, look, this isn't going to lead to a wage price spiral. That is the concern from the government. The unions are doing this, they say, because their members are being crushed by this cost of living spiral and crisis. Across the public sector, wages have risen about 3%. Inflation here in the UK about 10.5%.
Okay, so Tom, we seem to have been covering this story for a very long time. And as you say, it is getting more real. It is getting into people's homes with teachers now going on strike. Are we seeing any signs of reconciliation, anything that's bringing the government and the unions together?
There is one union within the rail sector, the TSSA, which says they've been offered some amended offer from some of the rail network companies or rail companies. Apart from them, though, it looks like there's gridlock largely across these unions in terms of their conversations with the government. We spoke to the TUC earlier today. They didn't push back on the idea that you're going to get further coordinated action in the weeks and months ahead. And in fact, on Friday, the railway workers are striking again. Next week, you have NHS workers, ambulance staff, and nurses coordinating strike action next week. The government's response is this: if they go ahead and they agree on these double-digit wage price hikes, or wage hikes, I should say, then they're going to just embed inflation into this economy, and that's going to create more pain across the UK. They are pushing back, the UK government, on that prospect. They say their number one priority is cutting inflation. They cannot agree to these hikes. There's also a strategy here from the government. They are hoping that public support for these strikes is going to start to ebb. But for now, the polling suggests that the public blame the government for this industrial action.
Tom, thanks very much for the update. Bloomberg's Tom McKenzie, as he says, outside a London station, keeping track of what's going on with strike activity today. Now, on to other news. The crisis of confidence plaguing Gautam Adani is deepening. The stock rout, triggered by short seller Hindenburg's fraud allegations, has erased a third of the market value of his group companies. Meanwhile, Bloomberg has learned the private banking unit of Credit Suisse has stopped accepting Adani bonds as collateral for margin loans. Bloomberg's finance editor, Tom Metcalf, has the latest. And Tom, we should keep saying, of course, the Adani Group dismisses, disputes all of the findings in this Hindenburg research, fraud and otherwise. So they push back against it. But in a sense, the story has momentum of its own. Losses now hitting $93 billion for the Adani empire.
Yeah, we're sort of back in meltdown territory, at least when it comes to their stock. So I think I saw it's now down 30% today, or sort of around that territory. So incredible change. And, you know, I think that's largely because of the sentiment. So yesterday you had good news for Adani. They completed this 2.5 billion share sale, but the sentiment hasn't sort of sustained itself. This Bloomberg report has sort of not helped matters. It's hurts people's confidence in sort of the company.
This is the report around Credit Suisse. What have they been saying?
So basically, Credit Suisse's private bank is no longer accepting some Adani shares as collateral for loans. So basically just saying they don't want that risk on their books. Yeah, clients have to come up with different shares. So, you know, a small piece of the puzzle, but part of this big sort of quite gloomy picture growing around Adani.
Yeah, and it just makes it even gloomier, hence the slide that we've seen this morning. Tom, thanks so much for joining us. Bloomberg's Tom Metcalf there talking to us about Credit Suisse no longer accepting Adani bonds as collateral for loans. Now, Snap, which is, you know, Snapchat, obviously, is slumping after forecasting its first ever quarterly revenue decline. The company is citing a flurry of changes to its advertising products that may be disruptive to its business. Bloomberg Quick Takes Alex Webb joins us now for a story on Alex. This is a company that has set off market slides before, even if the kids are the ones who mainly use it. Investors pay attention.
Yes, it's the company which tends to report before a lot of the other social media or indeed digital advertising companies, but because it is seen as the social network, historically at least, that had the greatest popularity among that really attractive, 18 to 30-year-old demographic that advertisers so love, it's therefore seen as something of a bellwether. And it's not had a brilliant quarter. It was flat in the fourth quarter compared to a year earlier. It attributes this, of course, to the broader advertising market. There is also concern, of course, that TikTok is taking some of its lunch. We're looking towards Facebook later in the week, whose demographic isn't quite as attractive necessarily, but it is a lot bigger than Snapchat. So it doesn't look brilliant for Facebook. They're going to be reporting a little bit later today.
Yeah, and on that point, as we await those Facebook Meta earnings, Alex, how strong a read-through do we expect when Snap says it's some of its internal changes that are contributing to this revenue decline that they're expecting?
I think that a lot of the commentary we're seeing out of analysts is that maybe as far as Snap is concerned, the internal changes aren't perhaps as significant as the external factors. Facebook, they're going to be looking to see in this year how spending is evolving. The kind of historical data on what's happened in the most recent quarter, of course, will be interesting. It's going to be the outlook that is far more significant and how we're going to see a stock reaction. Is this year going to be any better? But equally, is Facebook tamping back a little bit on the tens of billions they're spending on getting into what they call the metaverse, augmented reality, virtual reality, and so on? Is that spending going to be tapped back? That is something that a lot of investors want, and any commentary around that will probably be reflected in the share price.
Alex, thank you very much. Bloomberg Quick Takes Alex Webb with the latest on tech, the things we know and are soon to know about the tech universe. Now, coming up on this program, it is Fed Day. Have we mentioned that? I think we've said it a few times. It certainly is. We'll be speaking to Mickey Levy, who will be joining us, Berenberg Capital Markets chief economist for the US and for Asia, who says that the Fed's recent anti-inflation zeal will fade as inflation continues to moderate. We'll get the analysis behind that call. Hugh Roberts also joins us with what this means for markets. Quant Insight head of analytics. Plus, as Boeing bids farewell to its iconic 747 jumbo jet, the company welcomes self-flying technology into commercial aviation, or at least says that's where the future lies. More from our exclusive interview with the CEO of Boeing coming up shortly.
As you may know, we have an application on an all-electric autonomous airplane. We refer to as WISC. And that airplane, that application is in, and the FAA will begin working with us today on building out a certification program for autonomy and for WISC.
No one can claim that climate change is somebody else's problem or shrug it off for future generations to address. We're all affected by a warming planet. We see that every day. And decisions being made right now will determine our shared tomorrow. So we must choose, and we must act as united nations ourselves. Our progress depends on collective action, on collective ingenuity. If we stick together, we can make fixing the climate the greatest project and greatest achievement of our lifetimes. We have the science, we have the solutions. Now all the world needs is political will. Together, we can create a future where rampant carbon is removed from the atmosphere, where green buildings and green business transform the livability of communities.
Why is it that whenever there is like a scare coming along or a pandemic or something, people rush to buy toilet paper? Have you noticed that? People are just, they're stockpiling toilet paper.
It's
Is that
called a hoarding,
Hoarding,
and
okay.
it's one of those things you never want to be without.
Welcome back to Bloomberg Surveillance. This is the early edition. I'm Matt Miller with Kaylee Lyons here in New York, Anna Edwards with us out of London. For those of you listening on radio, because we are simulcast on radio and TV, I'm looking at a chart that shows a series of Fed hikes, the likes of which we haven't seen for decades. Really an unprecedented 450 basis points in a year. And yet, financial conditions have loosened to the most in more than 12 months. Joining us now to talk about this is Phil Serafino, Bloomberg Senior Markets Editor. Phil, what does this mean? As financial conditions get looser and looser, the Fed hikes less and less. Do they really want to stop inflation?
You know, the market is testing the Fed's resolve right now. That right edge of that chart where it shows the financial conditions getting looser, that does not make the Fed's job any easier. You know, the market has been pricing in the best possible outcome from this. You know, the S&P 500 up 6% in January, best start to the year since 2019. The NASDAQ up 10%. You know, that is a lot of short-term momentum, and the market is pricing in that the Fed is gonna pull back here and basically signal all clear.
And Phil, it's interesting, as you point out in your notes, that the Fed has killed rallies in the past. Jerome Powell has killed rallies in the past, something we need to keep in mind.
Yeah, that happened last summer. In July, the market took a very positive view of the Fed's intentions, and Powell came back at the end of August in his Jackson Hole speech and really put a damper on that with a very hawkish tone. You know, the question is, how concerned is he about inflation? Does he feel the market's gotten ahead of itself? I was just looking before I came on. I mean, the signs are everywhere that investors are almost euphoric. You know, in Europe, there was $1 trillion of bids for bonds in the month of January. Investors just can't wait to get their hands on fixed income. In the U.S., tons of junk-rated companies are refinancing. It's a bit of euphoria, and the same thing in equities. So, yeah, the market is signaling an all clear, and if Powell does not back that up, it's hard to see how the market can go higher in the very short term.
Okay, Phil, thank you very much. Thanks for your time. Phil Serafino, Markets Editor, Bloomberg Senior Markets Editor, with views on the markets as we head towards that Fed meeting. All important. And of course, the Markets Live blog will be all across that. You can get further market analysis on the Markets Live blog. MLID Go is the function to use on your Bloomberg terminal. This is Bloomberg.
No one covers the world like Bloomberg.
Return to pragmatism is really that everybody's in line. The government, the enterprises, the people, in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt, with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority.
So many people recognize you because you have a very famous hairdo that I've asked you about before. But to some people, they may say, well, Ken, what happened? Where did that hairdo come from and where has it gone? Because right now it seems a little different than what I've seen before.
Yeah, it's growing out a little bit, David, but COVID, you know, I ended up with hair going back down to my shoulder, and I finally realized that one of the things I had to do, I'm a very loyal person, and I used to have hair down to my waist in my college and my hippie days before that in Ann Arbor, Michigan, and I had it cut off in the summer of '75, and I've gone to the same person, now a grandmother many times over, who was a young gal cutting hair in Amherst, Massachusetts, and I still seek her out, and I finally just said to her, you know, COVID's enough of a change that I ought to be able to do something new.
Growth forecasts are increasing and inflation is falling. Will the European Central Bank make its fifth rate hike in a row? How high do rates need to go? Bloomberg Television and Radio brings you the breaking news from Frankfurt and detailed analysis after ECB President Christine Lagarde's press conference.
The central banks, and certainly the ECB is pushing this line, have got much more wood to chop. They've got much further to go.
Coverage begins Thursday, only on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. Investors hurt last week by that malfunction at the New York Stock Exchange are trying to get their money back. But Bloomberg has learned that claims are likely to exceed the liability pool that covers losses. Those losses could total in the millions of dollars. Intel is slashing the base pay of CEO Pat Gelsinger by 25%. Other managers will also take pay cuts. That comes a week after the chipmaker predicted one of the worst quarters in its more than 50-year history. Meanwhile, Gelsinger wants to preserve cash for an ambitious turnaround plan. And former South Carolina Governor Nikki Haley plans to announce she's running for president. She would become the first Republican to officially challenge her former boss for the nomination. Haley was ambassador to the United Nations under Donald Trump. Meanwhile, Trump himself has raised less than $10 million after he announced that he's running. That's seen as a disappointing haul. So, Anna, Nikki Haley would be one more hat thrown in the ring. We wait to see who else might do the same. DeSantis, Pence, Pompeo, all potentially could be competing for that Republican nomination. That battle likely to be fierce.
Yes, some well-known names there, of course. We'll get back to the markets conversation shortly then. Kaylee and Matt, we'll talk to Mickey Levy, Berenberg Capital Markets Chief Economist for the US and Asia. This is Bloomberg.
going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It's the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The Fed set to slow down interest rate hikes again, but policymakers are likely to hammer home the message that their work is not done yet. It's the UK's worst day of strikes in more than a decade. Hundreds of thousands of workers are staying off the job, demanding bigger pay hikes to offset inflation. And more signs of how big tech is doing. Earnings from Snap disappoint. Next up, Facebook parent Meta Platforms. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons over in New York. And Matt, US equity market futures a little bit softer this morning. You wonder if it's the earnings stories, perhaps the focus on big tech, and the focus on margins really coming through in terms of the way the market is responding to the various earnings report we get from these companies.
Yeah, although tech has had like the best month in a couple of decades, so maybe they're just taking some profits off the table. Also, of course, we do have a Fed meeting coming up today where Jerome Powell is widely expected to reduce his pace of rate hikes once again, and in order to make that not look as dovish as it is, he's got to do a lot of really hawkish jawboning. So maybe that's what these markets are preparing for. The S&P futures are down about 0.4%, so those losses accelerating a little bit, and this is slightly unusual for a Fed day because typically almost nothing happens ahead of a Fed decision or ahead of a non-farms payrolls report. Traders sit on their hands and wait until they get the details to parse through with human brains rather than letting the algorithms continue to run everything. The U.S. 10-year yield comes down about 3 basis points. So it's interesting, investors are buying bonds ahead of this Fed meeting. 347.54 is the U.S. 10-year level, if we take it out 5 significant digits. And then NYMEX crude continues to gain from where we saw it yesterday. Remember, a 76 handle at this time, which I thought was interestingly low. Now we're getting back closer to 80, 79.06 for a barrel of West Texas Intermediate. There have been, I think, renewed concerns about global growth slowdown in the last few days, and maybe those are coming off a little bit today. Gold right now is down about $2 at $19.26. So gold for a few weeks, a couple months now, has been up over 1,900, maybe a month. And I think it's interesting to watch this climb as the Fed reduces the pace of rate hikes, and as Bitcoin does a whole lot of nothing right now at 23,000. Kaylee, what do you see in terms of pre-market market movers.
Well, I'm focused on Snap. Do you use Snapchat, Matt Miller?
Yeah, all the time.
Do you? I think you're being facetious. I use Snapchat all the time. I have an 1,894-day-long Snap streak with my husband, actually. It's one of my biggest flexes, yet doesn't seem to be helping the company very much. That stock is actually down about 15% before the bell. It is forecasting its first ever quarterly revenue decline, and really that is all about the slowdown in advertising and changes to its advertising products that could hamper the business. So a punishment for those shares in pre-market trading, and it's trickling through to some of those other advertising-reliant social media peers. Meta, which reports after the bell today, down 1.5%. Pinterest is down by 2%. It is a brighter story, though, for AMD. The chip maker reported after the bell yesterday. Yes, it is seeing weakness in PC chip demand, as we saw with Intel, but in the server business, which is lucrative, it's helping to offset that. So the forecast was actually better than feared. That stock up about 3.25% before the bell, Anna.
Okay, so we're focused on tech and elsewhere in the US run up to the session then, Kaylee. This is the European picture. As Matt was saying, perhaps that move in US futures a little outsized compared to what we normally see on Fed Day. We're seeing small moves on European markets, up by 0.2% though in this stage of the trading day. Some of the travel and leisure stocks not doing too badly this morning. Vodafone, though, weighing on the telecom sector. That's one of the worst performing sectors this morning. Vodafone, the phone operator, down by 2.2%. The CEO saying they could do better. Novartis is down by 1.9%, as that business talks about a lack of climate for investment in Europe. That's the message from the CEO conversation that we had earlier on in programming with Vas Narasimhan, the CEO at Novartis. And Eurodollar, 108.89, not moving all that much. We've got a slightly softer print on inflation than had been anticipated for the Eurozone, but perhaps that picture has been gradually building. Of course, we're heading towards a Fed then, Matt, that is going to hike by 25 basis points, we think, and an ECB that tomorrow could hike by 50. That's an interesting one to debate and where this one goes. But you have other breaking news for us.
I do. Well, Gautam Adani, this may not come as a surprise. He has lost his spot as Asia's richest man to Mukesh Ambani. Of course, we've seen the value of Adani Enterprises as Adani Enterprises, Adani Group, the whole, I think there are at least 10 stocks on the Bloomberg that I'm following at any given time, drop by almost $100 billion now. He has lost, I think, $48 billion this year. So clearly he was going to slide down the wealth table. If you type RICH Go, Rich Go on the Bloomberg terminal, you can see a list of the wealthiest people in the world. And he had been, I think, number 4, Asia's richest man, but he has now lost that spot to Mukesh Ambani and just slid down the table.
Yeah, that's a story we're going to continue to follow, I'm sure, over the coming days and weeks, Matt. But what we are following today is the Federal Reserve and Chairman Powell in the press conference. So let's continue that now. Mickey Levy, senior economist at Berenberg Capital Markets and visiting scholar at the Hoover Institution at Stanford University, is joining us now. Mickey, we essentially know the move is going to be 25, so it's going to be up to the chairman. How hawkish do you expect him to be, and will the market buy it?
Well, Chair Powell is going to basically have to say, we're not done yet. Let's put things into perspective. A year ago, the Fed had the funds rate anchored at 0 when inflation was soaring over 5%. And historically, the Fed has always raised the funds rate above inflation in order to dampen inflation pressures. And so they're not there yet, and Powell has to convey that point. And also emphasize that, when you look at economic conditions, they've held up fairly well. And so he will have to basically say, we've slowed our pace of funds rate increase, but we're not done hiking rates yet.
Okay, Mickey, good morning. But you think that this is a politically attuned Fed that will find it difficult to keep hiking rates if we do start seeing damage to the labor market?
Well, that's right. I mean, it's been very easy for the Fed to convey a hawkish tone when the unemployment rate's 3.6% and the economy's strong. But let's see what happens when labor markets start to weaken in response to the Fed rate hikes and the higher inflation. And recently we started to see some cracks. We're going to see the JOLTS data today, but I'm expecting labor markets to start to show weakness. Now, keep in mind, fourth quarter GDP, you had a significant inventory overbuild that was undesired, and product demand was quite weak, and the first quarter should be weak again. So the first quarter is going to be all about businesses slowing down production and probably slowing down their employment gains. And let's just see how the Fed responds. And I think what it's going to do is in the next couple months say, well, you know, the balance of risks is becoming a little more evenly balanced, and that'll be what the market's focusing on then.
Well, and Mickey, I wonder if this shows that the Fed hasn't got the credibility that it's aiming for. If you look at world interest rate probability screen on the Bloomberg, the WERP GO function, you can see that the market has priced in a terminal rate of 4.9%, even though the Fed has 5.25% in its dot plot, and that the market expects the Fed to cut this year down to below 4.5% in terms of its effective Fed funds rate. Even though Fed speakers have said they're going to hold at this level for a long time. You know, have they got no credibility, or does a long time only mean a few weeks in Fed speak?
So, Matt, I totally applaud your focus on credibility, because the Fed has lost a lot of credibility. Let's face the facts. They really misjudged and misforecast the rise in inflation. They dithered. They finally got into action, raised rates last year. And what we've learned over the last year is actions speak louder than words. And the Fed has been trying to, use its forward guidance to influence the markets. And so actions are going to have to speak louder than words, and that's how the Fed will gain credibility. And so that's why they have to keep hiking. But your point's a great one, because when we think about the disinflationary process, it's all about lowering inflationary expectations and lowering aggregate demand in the economy so as to affect wage and price setting behavior. And the Fed still hasn't gone far enough yet. And so I love your question.
Well, you say the Fed hasn't gone far enough yet after misjudging the rise in inflation, and now is the risk of misjudging the decline in inflation. Where do you put the odds that the Fed pulls back too early, doesn't actually finish the job, so after staying at whatever the terminal rate ultimately is for a while, they have to hike again down the road?
Well, I think that's a great point. And this is a concern within the Federal Reserve. They know they have to raise rates a little further to get it above inflation. They have to raise rates enough to slow aggregate demand sufficiently to take away some of that business pricing power. But if they hike rates too much, then the economy will go into recession. So I think the market may be misperceiving the Fed, and Powell may get that notion across today, saying we're going to have to hike rates above inflation and keep it there until the economy slows significantly enough and labor markets slow enough to bring down those wages and price increases.
Mickey, thank you very much. Thanks for joining us. We do appreciate your time. Mickey Levy of Berenberg Capital Markets on Fed Day. Important economic conversation. We'll zoom in onto the markets and how they might respond to what the Fed is going to say. Coming up, Hugh Roberts joins us, Quant Insight, Head of Analytics. This is Bloomberg.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Let's get back to the Fed as investors brace for that policy decision due at 2 p.m. Wall Street time. Joining us now here in London, Hugh Roberts, Head of Analytics at Quant Insight. Hugh, very nice to have you with us today. We were talking earlier on in the program about financial conditions, and Matt produced a chart, a Bloomberg measure of financial conditions. You've been looking at a different measure that actually excludes equities and therefore some of the wealth effects. What value does that add, and does it tell a different story, crucially, about how loose they are?
It doesn't tell a different story.
Okay.
It tells exactly the same story, that the Fed engineered tightening of 2022 has been completely unwound.
So it's not all about stocks then?
No, the wealth effect is clearly important, especially in the States. We run it for Europe, for Asia more broadly, but it does tell the same picture. I think the advantage of using it without stocks and the wealth effect is that we try and kind of focus in on true underlying credit conditions, liquidity conditions, so really more about the kind of nuts and bolts of the financial markets. You tend to find that the wealth effect, obviously equities rally, risk appetite moves accordingly, maybe the Fed then respond and you're going to get caught in this loop. So we try and just strip a bit of that noise away.
So excluding that still tells the same story, still tells us a story of a financial conditions picture that might be too loose for the Fed's comfort. So with that in mind, should markets brace for some significant hawkish pushback from the Fed today?
So we have an algorithm that takes a load of macro variables, but we don't have in our factor set any kind of Fed watching tools and a kind of criminology stuff that lots of very clever people look at, the hawks dropping off the 2023 voting committee, doves coming on, that kind of stuff is not really our bag. But what we do is we pull in things like nowcasting, for example, so daily tracking GDP growth moving up and down. So that's a good example, in fact. So after those horrible retail sales numbers a couple of Fridays ago, forward quarter real GDP in the States fell to just 1% real. So, really quite poor. Subsequently bounced back after claims last week. But that has been really a bit of a drag on our model for US equities. On the other side of the coin, and back to your FCI point, the move in bond vol or interest rate vol, which is our kind of proxy for QT expectations and what the Fed's doing with its balance sheet, that's really been actually easing a lot. Most people watch the MOVE index. That's now below 100 for the first time in ages. So the net of all that is that our completely mathematically derived model is flatlining. We were below 4,000 on the S&P, for example, at the turn of the year. We've moved up to just over 4,000. But since then, the markets have caught up to the model. We're flatlining. So like everyone else, I'm afraid we're waiting to see what Powell says tonight.
Hugh, I got to say, I believe the financial conditions indexes, Bloomberg's as well as yours, and what they're telling us. At the same time, just over a year ago, I borrowed far more money than was advisable to buy a house at the very top of the market. So when I woke up this morning and saw a headline on the terminal, housing slump from U.S. to China adds risk to global economy, my heart kind of fluttered a little bit. I'm a little bit freaking out about the housing situation. And being that you're in London, I figured I'd ask you, does it freak you out as well? Because the UK is having a pretty tough time of it as well.
Yeah, absolutely. It kind of feels at the moment that what we've got in the UK is that kind of phony war period whereby what actually the bear market initially is in activity, that there's an impasse between sellers refusing to lower their prices and buyers refusing to step up. Yeah, I always think you have to think about the housing market in kind of two ways. There's the activity side, the volume side, if you like, and the prices side. Thus far, it's volume that suffered. Prices have come down a bit, but arguably not as much. But I agree with your point. The direction of travel has to be that way for all the kind of countries that have big housing markets and interest rate sensitive dynamics like UK, Australia, Canada. To your broader point, I guess it's really about the fact that most consensus studies suggest that all the stimulus that was afforded to consumers during the pandemic and the lockdown period are still around. They're probably going to dissipate by the back end of this year, and that's really when we start to get worried.
Well, Hugh, speaking of asset prices coming down, among risk assets, what is looking most vulnerable to an outsized hawkish surprise at this time?
Yeah, so on our modelling, S&P and large caps and also small caps, looking at the Russell, are a little bit rich, but close enough to model value to not get excited. The one area that this early kind of 2023 Goldilocks narrative has really fueled has been tech. So NASDAQ is rich in our model. The speculative tech sector in particular, if you're looking at kind of the ARCs of this world, they've all kind of moved above where macro conditions say they should be. So I guess if we're looking at it from a risk-reward perspective for a near-term trade, if you do fear that Powell's going to talk tough, then that's the area that looks most vulnerable to us.
Okay, yeah, NASDAQ up by 10% year to date, outperforming European stocks, which we talk about more perhaps since the start of the year. Hugh, thank you so much. Thanks for joining us. Hugh Roberts of Quant Insights. Coming up, we will get back to a really fascinating story from this week. Boeing ushers in a new era. The company sees self-flying tech, yes, coming to commercial aircraft. More from our Boeing CEO interview next. This is Bloomberg.
make it very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
The top names in business are on Bloomberg.
Different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but the vulnerabilities that amplified previous recessions around the world are not present. That omens well for a mild recessions when they come.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Now, a quick look at what is coming up for the rest of the day. House Speaker Kevin McCarthy will preside over a closed-door session with Republicans at 9 a.m. Eastern Time to discuss strategy on the U.S. debt ceiling before a meeting with President Biden. Then we'll get some key U.S. economic data out today, including JOLTS and ISM manufacturing, and, of course, the big event, the Fed decision at 2 p.m. Eastern, followed by Chairman Powell's press conference. Plus, the earnings parade continues with Meta and Peloton due to report results, Matt.
All right, now Boeing's CEO says it's a matter of when, not if, self-flying planes, electric self-flying planes, will debut in commercial aviation. Dave Calhoun spoke exclusively with our own Guy Johnson in Everett, Washington.
I think the future of autonomy is real for civil. It's going to take time. Everyone's got to build confidence. We need a certification process that we all have faith and believe in. As you may know, we have an application on an all-electric autonomous airplane.
Yep.
We refer to as WISC. And that airplane, that application is in, and the FAA will begin working with us today on building out a certification program for autonomy and for WISC. So there's so much to learn, so much to do, but it is being done.
You talk about autonomy, the amount of software that's going to be required, the amount of code that's going to have to be written, the amount of innovation that's going to have to take place to make that happen is absolutely huge. Amazon's down the road, it's laying off talents. Microsoft's down the road, it's laying off talent. How do you are you trying to actively attract that talent into Boeing, and how are you doing that?
Oh, of course, the answer is yes. And I think our industry and Boeing have been very successful. It's maybe the little secret in hiring. We had 15,000 hires last year. We'll hire another 10,000 this year. Why did they come? It's not because they're tired of their Silicon Valley moment. It's because they wanted this mission to connect, to protect, to explore the world.
Most of those are engineers.
Yes.
Are they coming from Amazon? Are they coming from Microsoft?
Many are.
So
all of them? No. Many of them are. We've never had trouble with that. Do I think the layoffs make it maybe a little easier? Of course. But it's still about who you get. It's not an engineer is an engineer. You're always looking for the best talent in the world to take on one of the great missions in the world. And that is what we're doing.
You talked on the call the other day about a narrow body, a braced wing narrow body that you're pursuing. And you're talking potentially about building a prototype at the end of this year. We just spoke about the fact that you're not having any new aircraft, but I'm wondering where this one is going. Clearly, we're kind of running towards the end of the life cycle of the 737. I'm curious as to whether or not this aircraft, this narrow body you've talked about with these super long wings that are braced, that kind of dip at the airport, could be that aeroplane.
Yeah, they call it the transonic truss-braced wing, and yes. So that's a program that's been in development for quite some time.
You're doing it with NASA, right?
To prove out that it's worth it. And what does worth it mean? Somewhere in the neighborhood of 25–30% improvement from today's commercial airplane, today's narrow body, if you will. So now we have to prove that it can be commercialized.
Boeing CEO Dave Calhoun speaking exclusively with Bloomberg's Guy Johnson in Everett, Washington. I thought it was one of the best interviews I have heard in a long time. I recommend that viewers and listeners go to our website and watch it all in its entirety, especially because of his comments on recession, Kaylee and Anna. You know, he's got such a great view of the economy from his position, and he said very forcefully to Guy, he does not see a recession coming, and Boeing continues to hire and sees more business coming its way.
Yeah, well, as we continue to take soundings on the U.S. economy and the global economy from all kinds of chief executives, and that's certainly an interesting one to put into the mix. I like the comments on innovation as well, the world-changing innovation that plane represented, and how he thinks that is still absolutely something that happens at Boeing and within the aviation sector. That is it for Early Edition. From Matt, Kaylee, and I, surveillance is ahead. This is Bloomberg.
about cryptocurrencies? Are you a believer in cryptocurrencies?
No, I'm not a believer in cryptocurrencies, and I would say that cryptocurrencies are a bubble. And I would describe cryptocurrencies as a limited supply of nothing. So to the extent there's more demand than the limited supply, the price would go up. But to the extent the demand falls, then the price would go down. There's no intrinsic value to any of the cryptocurrencies, except that there's a limited amount.
Well, based on what you've just said, why would you not put a big short of some type on cryptocurrencies? Or maybe you have, but do you think that's a good short?
Well, you know, when we look for these subprime, the reason why we shorted the subprime in size because it was asymmetrical. You're shorting a bond at par that has a limited duration that trades at a 1% spread of treasury, so you can't lose more than the spread in the duration. Yet if it defaults, you can make the par amount. In crypto, there's unlimited downside. So even though I could be right over the long term, in the short term, as the case of Bitcoin, you know, went from 5,000 to 45,000, you know, I would be wiped out on the short side. So it's just too volatile to short.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
The Fed wants to see real yields higher, really to make sure inflation is down and stays down for a while.
The Fed is hawkish, but they're sort of reiterating a message that the market's already kind of gotten comfortable with.
There are a lot of structural forces at play that are not going to bring us back to 0% or almost no inflation.
They're going to be very careful about signaling that they're ready to pause and cut before they know it's the right time.
What the Fed does matters, and it matters a lot for the global economy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It is Fed Decision Day, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Equity futures down 0.4%. TK, Fed Decision Day, tons of economic data, and Meta after the close.
Yeah, Meta, you wonder if the Fed had a Facebook page, would they have a better communication policy? I mean, it's a simple...
Relationship status.
Yes, exactly. But it's a 3-day marathon. Can we be clear that Jobs Day and the wage dynamic there is really important? Dominic Constant's coming up. He says there's no evidence of a wage price spiral, but that's going to come up today.
Would it make a difference to this Fed today if they had Friday's payrolls data right now?
It would not make a difference in the decision 50 or 25, but it would make a difference in his comments about what we're going to talk to Dr. Constam about, which is the extendedness of all of this.
And the easing of financial conditions that they might have to push back against. The NASDAQ 100 in the month of January, which has gone just like that, up 10.6%. Lisa, what a rally we've seen.
Which, paired together with the Fed, people aren't listening, right? And this is why I'm actually exhausted in advance for all of the Fed speak that we're about to do for the next however many hours.
Day, that's
no,
good
but the
to
reason
hear.
why, aside from that, it's not about what the Fed says. It's about the data. Stop laughing at me.
Let's carry on,
about
please.
the data. It's about what happens on Friday. It's about what happens with the earnings that we get. Because at this point, the Fed is just following behind the data. They are not out front. And that is the distinction.
What sparked the rally yesterday? The data.
The data.
Softening ECI. Will that continue?
And that's what we may see with the JOLTS data coming up later. We may see that with the ISM, although manufacturing hasn't really been the key indicator. But with the jobs report, to your point, if we get a big disappointment, that could potentially change the narrative and, frankly, lean into potential cuts later in the year.
I didn't realize we have JOLTS today. That's a big deal. I mean, I'm sorry. You know, McKee,
ISM as well.
McKee says it's a big... ISM is a John Farrow statistic. McKee's all over JOLTS. And again, that's the kind of data that informs when McKee asks Powell a question and there's this pregnant pause and then he doesn't answer the question. He sort of
can't wait for that.
Around it, you know.
If we put what you said together with what Lisa said, we've got a perfect promo.
It is a perfect
coverage
promo.
a little bit later. Chairman Powell not answering questions. Lisa absolutely exhausted with the Fed speak before the Fed decision even comes through. Here's the price action for you as we kick off the month of February. Equity futures negative 0.4% on the S&P 500. Yields come in a couple of basis points on a 10-year, 348.27. And TK, don't forget, in December, really robbing the headlines from Chairman Powell was President Lagarde. It's the ECB tomorrow.
Yes, I strongly agree with that, and to me it's a radically different story. You can disagree with me, which you usually do, but I don't think you can conflate the two together. And with the ECB, with a war going on, it's about the nominal GDP out there. There's no doubt in America there's a nominal GDP. It may be too much inflation and not enough real growth, but there's a spirit in America that you don't have over in Europe.
Lisa, will Chairman Powell sound like President Lagarde back in December?
Maybe, we'll see. And this is what I am watching, perhaps more than the Fed speak. Just to give you a sense, I'm not bored by everything. In fact, there's so much that's more interesting than the Fed. That is the reason why the Fed speak is perhaps diminished in terms of importance. The ISM manufacturing data coming out at 8:30 a.m. for the month of January. I know that you're looking at that, John, the expectation for a fifth straight monthly sub-50 read on that number really is getting people's attention. The JOLTS data, though, is what I'm looking at for December. Do we see job openings come down? This is a leading indicator for the employment market. How much does it reflect a true softening in a market that has remained robust? To me, this could potentially set the tone and be more market moving than any other data point today. 2 p.m. we do get the FOMC rate decision followed by Jay Powell speaking at 2:30 p.m. for that Fed press conference. Perhaps the Fed speak won't give us as much guidance as our guests, who are actually incredible. And so I'm really looking forward. Our special coverage starts at 1:30 p.m. Richard Clarida, former Fed Vice Chair, Priya Misra, Diane Swank, Greg Davis of Vanguard, all of them joining us. And then after market, I am watching Meta because Snap earnings were pretty dreadful yesterday in terms of their first potential quarterly decline in advertising revenue for this quarter. How much does Apple's changes to privacy really affect Meta in the same kind of way? Snap shares down more than 15%, John, after those earnings. Does Meta follow along with that, given that so much of their revenue really does derive from the advertisers?
Earnings reports from Snap, Tom. And Lisa, thank you. Do you want the price action, a one-day price action after the last couple of earnings reports from Snap? Down 28% back in October, down 39% back in July. You think there's a theme here?
I'm going to go without a discussion of Snap, of which I have no ability whatsoever. The thing that's changed here is the yield structure has changed. Shanali Basak with Nassim Taleb, he had my quote of 2022, the gravity's return to the system, and these companies without EBITDA, without free cash flow, they're in a whole new world after all.
It's the return of discipline. Dominic Constant joins us now, head of macro strategy at Mizuho Americas. Dom, is this hike today the penultimate hike of this cycle?
Well, it could be. I mean, we're very close, I think, to the Fed finishing. I think the key message, though, is they can't kind of tell you they're about to finish. They're going to obviously give a hawkish message around that. They could either sort of, in the second quarter, declare an outright pause like the Bank of Canada, or they could keep it more uncertain in a way that almost say that, we might be done, but we'll see how it goes. In the end, I think they're going to be done, though, around 5%. So this could be the penultimate hike on the back of that.
Dominic, two ideas here. You made worldwide headlines, I should say, was super restrictive the last time you were on. Is this the Fed nearing or in a super restrictive phase?
Yeah, I mean, they are super restrictive. I mean, it kind of depends on how you look at inflation, and we look at it very carefully in a lot of different ways in terms of the impact of inflation expectations, wage price spirals you mentioned earlier, and dissecting it in terms of demand drivers and supply drivers. And when you sort of dig really deep, I would argue the inflation story is looking very good. It is basically normalizing. We're putting to bed the fears that inflation was in a whole new regime. And when you look at that, then essentially when you measure a monetary policy in terms of restrictiveness, both in terms of real interest rates and financial conditions, there's only one conclusion, and that it is super restrictive. And you mentioned NASDAQ doing well, etc. But overall, financial conditions are still very restrictive. And there is a danger that as you squeeze out the excess demand and profit margins, you're in a hard landing before you know it. And that's why the Fed has to be quite careful of not pushing rates too high.
Dominic, week, we're going to talk to Richard Claret, founder of DSGE. We're going to talk about the time continuum on the x-axis. The way I see it, and you mentioned this, is an extended period of rates here or a little bit above versus pushing rates up to a higher rate level. Can extended and can an extended Fed substitute for the migration to a higher rate?
Absolutely. And I think the point is that the idea of the soft landing versus hard landing is like a sequencing. You can basically do the soft landing, keep rates an extended period elevated, but in order to avoid the hard landing, you need to scurry very fast to get back to neutral, which we think, and the Fed certainly still thinks, is around 2.5%. And that's a story for 2024. So the danger is of not doing extended, but just, for example, to keep on raising rates means you just got much more scurrying to do at the end of the day, and with more risk, I would argue, of making a mistake that you can't move fast enough if you're already, at say 6% funds. So it's basically staying around 5, getting to 2.5. That's doable. You do a bunch of 50 basis point cuts in 2024. It's quite aggressive, but they can do that, and that way they avoid the hard landing. This isn't a choice of soft versus hard landing. It's a soft landing until it becomes a hard landing, and that's why the Fed needs to be very alert to that reversal in policy, which we'd expect in 2024. Not this year, but 2024.
Dominic, I'm feeling a little bit philosophical as we talk about Fed communication and the market's response. If the Fed speaks and markets don't respond, did the Fed make noise, right? I mean, basically, if the Fed tries to give guidance, stop laughing at me, tries to give guidance, but the market doesn't sell off, is that actually effective in getting the Fed's, you're still laughing at me, in getting the Fed's message across?
Yeah, I mean, I don't think the Fed needs to get the bond market selling off. I mean, the bond market obviously is looking through all of this and discounting a pretty restrictive policy stance in terms of rates. Obviously, it's the financial conditions side of it. It's basically the dollar and credit spreads and equities. So I think if there's too much of a sort of relief rally in these things, then they can definitely push back and they can definitely sort of try and jawbone financial conditions tighter by introducing this uncertainty around maybe the peak in the funds rate, the uncertainty about how committed they are to actually a pause, and that's very likely they'll do that. I'm not sure they'll do that today. They could hint at that, but it's certainly very likely in Q2 or maybe in the March meeting to do that. And I think Larry Summers, I mean, he said something sensible over the weekend in terms of maybe the Fed shouldn't. I said that very carefully. Maybe the Fed shouldn't really pre-commit to hikes, and that's really would be an interesting thing if the Fed could perhaps have a bit more uncertainty around their policy going forward, even if they are effectively pausing with the benefit of hindsight.
That's the line in the morning, Dom. Run.
Oh,
just
God,
fantastic.
I've
got nothing left. I've got nothing left for the rest of the today.
Put it up there. Come on, Amy, give me that banner, please. Summers.
Something sensible.
Good morning, Professor Summers. And we look for the panel in London, Lawrence Summers and Dominic Constant. That'll be a great
He's still
panel.
in bed. Don't worry about it. He's not woken up yet. Dominic Constant of Mizuho Americas. Dom, thank you. That was perfect. Wasn't that perfect? Lisa, you've been spending time in nature. What was that about? All philosophical, in the woods, trees falling, all of that good stuff?
Okay, this is the conundrum that the Fed has. Their messaging depends on the market's response. If the Fed speaks and markets don't respond, did they get their message across? Did they affect the transmission that they were searching for? And it's a legitimate question, which is the reason why there's sort of this gamesmanship going on, this chess game between the Fed and markets right now.
I agree. I think it's actually the question going into this news conference, because we've asked a couple of people already what's important here, the data or what Chairman Powell's got to say. They're choosing the data at the moment, which says something about what they think about what Chairman Powell's got to say.
And perhaps Chairman Powell doesn't care. Perhaps Chairman Powell is saying, look, you guys have it better than I do because you're the, collective minds that are coming together to price out the potential economic trajectory.
That spread's got to reconcile, Tom. How it reconciles is one of the big questions over the next couple of quarters.
I hope to say something sensible in the next 3 hours.
We'll go talk with Summers.
Larry Summers actually said something sensible.
And Tom tried to banner it.
Thank you, Tom. Futures down 0.4% on the S&P. Live from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Policymakers at the Federal Reserve are expected to moderate interest rates and increases again today. The Fed is wrapping up its two-day meeting. Chair Jerome Powell is likely to keep further rate hikes on the table, while leaning against bets the central bank will cut later this week. Inflation in the Eurozone, well, that slowed down more than expected in January. Last month's reading came in at 8.5%. That suggests there will be a more heated debate to come at the European Central Bank over how much more interest rates should rise. The UK has been hit by its most severe day of strikes in more than a decade. As many as 475,000 union members are on strike today, closing schools, crippling the nation's rail network. They're demanding pay hikes to offset the cost of living crisis. Investors heard last week by the malfunction at the New York Stock Exchange are trying to get their money back.
Order
But Bloomberg's
to
learned
sell
that claims
short
are likely
Bitcoin,
to exceed the
and the
liability
price I'm
pool
looking
that
to
covers
sell
losses.
23,000.
Those losses could total $8 million. The crisis of confidence plaguing Gautam Adani is getting worse.
So
The
if you
stock
want
sell-off
to
triggered
trade
by Hindenburg
Bitcoin,
Research's
please
fraud
place your
allegations
order. If you
has
do
erased
private
a
trade
third of
or
the value of his companies.
just follow my
That's more than
trade,
$90 billion.
stay
The
tuned,
flagship company,
and as soon
Adani
as we will
Industries,
fill the order,
lost as much as 20%
I
today.
will let you
Global
know
news
what we're
powered by
going
more
to do
than
next.
2,700 journalists and analysts in over 120 countries.
We will
I'm Lisa Mateo.
wait until, at this moment, we'll wait until the order will be filled. So you still have time until all order will get filled. Okay, guys? I'll speak to you later. Stay safe.
Politics to the world of business. Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The Fed is expected to dial back to a 25 basis point hike.
They want to make sure they don't go too far.
A pivotal moment to make some decisions.
But will they go so far as to signal a pause?
We have a long ways to go.
Trust Bloomberg for the fastest coverage and exclusive analysis, including former Fed Vice Chair Richard Clarida.
Recession fears are tangible.
What's the mistake this year? Doing too little or doing too much?
Stay tuned. This is going to be with us for a while.
Bloomberg Surveillance. The Fed decides. Today on Bloomberg, your global business authority.
Folks, just outside this space, the first piece of the new Hudson Tunnel is being built. It's one of the biggest parts of the Gateway program. Now, let me say this at the outset. This is just the beginning. Americans see these projects popping up across the country, and it sends an important message that we're going to, when we work together, like we did in the bipartisan law and the CHIPS law, there's nothing we can't do.
the President of the United States there. Good morning to you all. The price action this morning looks a little bit like this going into the Federal Reserve decision a little bit later on this afternoon. Equity futures down by 0.4% as we kick off the month of February. I really don't know where the last month went, but it went like this for the NASDAQ. The NASDAQ up big time, up more than 10%. Three things to watch, not just Chairman Powell later, also the economic data later on this morning and some earnings from Meta after the close to kick off things for big tech this week. Look over to Europe, euro dollar 108.94. We're positive there, a third of 1%. Downside surprise on CPI for the Eurozone going into the ECB, but with a monster asterisk. Where's Germany in all of this? Capital Economics publishing just moments ago, and they said this: January's drop in headline inflation should be taken with a pinch of salt because of a data processing problem meant that the data for Germany had to be estimated and might therefore be unreliable. In any case, they went on to say, Lisa, the key point is that core inflation remained at a record high, so the ECB will remain very hawkish.
To me, that was my takeaway, is that, yes, on the headline number, you did see a deceleration. It came from energy. It came from uncertainty in some of these readings. On the flip side, core inflation, still very hot. And so, therefore, the ECB's narrative really doesn't change.
Expected, Tom, to go 50 basis points tomorrow.
Is that, I'm not there.
Well, we've had the guide from the ECB.
No,
I think
the
President
ECB,
Lagarde basically told us that herself.
Okay, but what's the damage they do with that? I just don't have a
pricing it
nominal
in.
GDP
But
figure.
here's the thing: the market's already pricing it in. It would be disruptive if they went 25 basis points in a way that they didn't necessarily want.
The big reset yesterday, I mean, you're right, but to me, a big part of this is the GDP numbers came in not as gloomy as the gloom crew.
Sure.
To me, that helps Lagarde with 50.
The green light's on. They're going to go 50. Will they go 50 again after that?
Are
The
you
guidance
flying
seems
over
to
there
be.
tonight? Are you going to be in the
They
lawn
might
again
be. I don't think I am. I think I've got a long day this afternoon, Tom. But maybe I can make that flight.
I'll take the golf.
Would you like me to skip the Fed? Would you like me to skip the Fed?
Have you ever had a Schaefer's beer?
A Schaefer's beer?
Schaefer.
No.
Then they were bought up by Stroh's.
Okay.
And then PBR, Pepsi Blue Ribbon, took them all out.
I trust we're going somewhere constructive with
We're
this.
going somewhere constructive. What do you do in Washington when you've got to get the two sides together? Anne-Marie Horton knows this because she's a student of history. In June of 2009, it was President Obama, Vice President Biden, Gates of Harvard, and other attendees quaffing beers in the Rose Garden. Maybe we'll see that today with McCarthy and Biden. I mean, there's theater to all this. Anne-Marie, what is the theater today of McCarthy meeting with Biden?
Well, Newt Gingrich called it like a first date. This is the first moment since McCarthy took the speakership that these two men will be sitting down together. And you're not going to get any news on they reached an agreement when it comes to the debt ceiling, which is obviously this debt ceiling is what is hanging over them during this first meeting. But it is a chance for them both to size each other up. So, Tom, you are correct when you say this is really about watching the optics, watching the body language, and seeing the statements that comes out of this meeting.
What is the body language that a really interesting set of the GOP want from their speaker? I think, Anne-Marie, particularly for our international audience, this is a complete mystery. Is McCarthy one of them?
Well, he's not exactly one of them, but what he does need to show is that he can deliver. He had 14 rounds of a chaotic, very dramatic speakership, and he cut some deals with the far right of his party, and he needs to be able to deliver on some of these promises, which is why this is going to be incredibly challenging for him when you have the President of the United States and the Democrats, which still control the Senate, saying that we are happy to look at the budget and talk about potentially some fiscal reform, but we will not do it, and we will not hold that hostage when it comes to the debt ceiling. The Democrats really see this as a two-lane process, and the Republicans are going to see it as one.
President Biden yesterday was talking about Kevin McCarthy at one of the fundraisers, and he said that he was a decent man, but that he had to cater to some, quote, off-the-wall concessions, and then said, look, this is not your father's Republican Party. No, I mean it. This is a different breed of cat. What is the breed of cat in terms of the leadership for this next race that we see?
Well, we do know that we only have one, at the moment, Republican candidate running for 2024, if you're talking about the 2024 presidential election, and that's the former President Trump. But we have reporting from Mario Parker out overnight that Nikki Haley will be announcing her campaign February 15th. So she is the first of her former bosses. We know that there's a few that have insinuated they want to get in the race, but she is the first that is going to make this formal announcement. And, you know, she recently said, and Jonathan brought this up the other day when she was interviewed on Fox News, she said, you have to look at the situation right now, and does the leadership match the current problems? She said she didn't think it did, and that she thinks she could be the one to match the moment. So she's getting in the ring.
Former President Trump also thinks that he's the one to match the moment, but he's not really raising that much money relative to the others. What is the likelihood that he could forge some sort of independent race, which really might be, in some ways, the Democrats' best option?
No, I mean, Trump, if he runs, he's running on the Republican ticket. And while, yes, the fundraising has been lackluster, and the New York Times goes through that data perfectly this morning in terms of sizing him up versus past early days of a presidential race. When you announce you're going to be president, you do this with timing to know you can bring in those campaign dollars. I believe what the Trump campaign is bringing in per day is about $200,000 in their first critical few weeks. Compare that to former Governor Jeb Bush or Hillary Clinton when they got into the race. These were $600,000, $800,000 a day. So Trump at the moment is not bringing in the money. It could show that he is losing a grip on the party, but I don't think this is a moment that you write him off, that he would not be the individual if he was to make it to the top on a Republican ticket, and that he would step aside and run as an independent.
Well, AMH, doesn't the fact that Nikki Haley's getting ready to run really underscore the fact that he is losing grip on the party? This is an individual that pledged not to if Trump made a run.
Yep. April 2021, she said, if my former boss runs, I will not. But Trump recently was talking to South Carolina local television, said that Nikki Haley had called him and he had told her, if your heart's in it, you know, you got to do what your heart wants to do. But Trump hasn't really gone after Nikki Haley just yet. But he has gone after the governor of Florida, Ron DeSantis, especially when it comes to COVID. He said Florida was locked down longer than it should have been, and started attacking him. So I would say that his real concern is if a Governor Ron DeSantis gets in the race. At the moment, it doesn't seem like he's taking aim at Nikki Haley. But also, it's very early on, and this is going to be a wide field. We know that Mike Pompeo might throw his hat in the ring. We know that Mike Pence is looking at a run. I mean, there's a number of individuals who are sizing up whether they are going to make this case for 2024.
All to play for. AMH down in DC, Anne-Marie, thank you. As always, this could be really gripping stuff on the Republican side, Tom. Haley, Pence, DeSantis, Pompeo, Trump.
It ebbs and flows across hundreds of years. The Democratic Party used to be the nuts party. I mean, it goes way back to, I'm thinking Grover Cleveland, 1880.
Are you implying that the other party is now the nuts party?
No, but it ebbs and flows, where the Democrats were total chaos.
What kind of nut?
And then it comes back the other way. And clearly right now the Republicans have the chaos meter. John, what's really important here to bring up, and I know that someone like Anne-Marie Horton was so delicate that she never quaffed a Schaefer's or a Schlitz or a Stroh's or a PBR. My first British beer, Lisa, was John Courage Amber. And I remember tasting it and going, oh, this is what beer actually tastes like.
Actual beer.
Actual beer.
Yeah.
Is John Courage a fancy brand in England?
I don't think so.
Yeah, I just...
Is Bud Light a fancy beer in the United States?
No,
is that a big one?
Coors.
We got that right?
It actually
That's
is.
like legit.
Coors 3-2, I think, from
It's
Mrs.
definitely, you go into like a craft beer place.
What about Natty
Bud
Light? Natty Light, is that legit?
Look, I've got family from Milwaukee, so, you know, this is, you know, Schlitz, so you start going to this. Like, don't, you know.
The day they
I wasn't taking, I'm interested.
What?
I wasn't, you know, I'm not.
No, Bud Light
guys,
is
as you can
not
see,
a good
this
beer.
It's not a good beer.
It's pretty dreadful.
Short position, stay with me, 1% equals 1,000 pounds, and we'll close this trade with profit.
So good.
Okay, guys, if you want to buy, sell short, you can sell as well because it moves up. You can open position at any price. If you want to get the strategy, please go to company.co.uk and you can purchase strategy from our website. Otherwise, stay with me, copy our trades, and we'll finish this trade. We'll close this trade in profit. Okay? Stay safe.
No one can claim that climate change is somebody else's problem or shrug it off for future generations to address. We're all affected by a warming planet. We see that every day. And decisions being made right now will determine our shared tomorrow. So we must choose, and we must act as united nations ourselves. Our progress depends on collective action, on collective ingenuity. If we stick together, we can make fixing the climate the greatest project and greatest achievement of our lifetimes. We have the science, we have the solutions. Now all the world needs is political will. Together, we can create a future where rampant carbon is removed from the atmosphere, where green buildings and green business transform the livability of communities.
Why is it that whenever there is like a scare coming along or a pandemic or something, people rush to buy toilet paper? You notice that? People are just, they're stockpiling toilet paper.
It's
Is that
called a hoarding,
hoarding?
and
Okay.
it's one of those things you never want to be without.
The Fed decision just around the corner. Equities a little softer going into that. Equity futures on the S&P negative by what, a third of 1%, down 0.2 on the Nasdaq year to date. I know early days to say that, but 1 month of gains on the Nasdaq and the S&P 500. Pretty phenomenal stuff. The Nasdaq 100 up more than 10%, the S&P 500 up more than 6%. And Tom, maybe that might be a wise decision. Book it in. Take the gains.
Sell. Go to Florida.
In the bond market, 2s, 10s, and 30s. I'll talk about people going to Florida a little bit later in the program. Some phenomenal numbers. Some phenomenal numbers. Yeah. Your 2-year right now, 419.71 on a 2-year. Compare that to where the Fed's going to be a little bit later. The Fed is going to take rates closer to 5%. That inversion there is worth a longer conversation in just a moment. Your 10-year, 348.46. Yields come in a couple of basis points on a 10-year. Just to round things out in foreign exchange for you, yes, we did have a downside surprise on Eurozone CPI going into the ECB tomorrow. But, and there is a big but, we still don't really know what German inflation was for the previous month. And we've got to wait, I think, until next week to find out where German CPI is. Going into President Lagarde, Tom, we're looking for 50 basis points from the ECB.
And their German manufacturing is flat on its back. Is that the generalization?
We're expecting that to pick up in line with what's developing over in China.
Okay.
That seems to be the bottom line for most people.
Well, yeah, I mean, it's been an eventful January, to say the least, and we're going to do a lot of theory today. Again, our Fed special leads off with Richard Clarida. What an honor to have the vice chairman with us, but it is about the acuity of market economics, and I think it's just all in all going to be really, really something to focus on. We do that now with Rabila Faruqi joining us, Chief U.S. Economist, High Frequency Economics. Rabila, I'm going to cut to the chase. What has changed on your Excel spreadsheet in the last 10 days?
What we've been looking at really is how households are responding, and what we've seen is a pretty substantial deceleration in, household spending. That really is driving our, GDP estimates, and we expect a pretty big, slowdown in the first quarter. But, what we are seeing on the other side of it is a labor market that just remains very strong, and, fundamentals of the, households and household balance sheets are really haven't changed that much.
The broad theme for our listeners and viewers is France, China, on and on. Things are coming in better than expected. Can you say the same about the United States of America?
I can say that about the labor market. I can't say that about what we're seeing in the survey data. I can't say that about what we're seeing in household spending. So, the U.S. economic fundamentals, if you look at the basic, the driver of the U.S. economy is still in pretty good shape. Household balance sheets are healthy. Job growth is still very strong. But, we do think that the effects of, 400 basis points of tightening are going to start filtering through the economy. They're already showing up in manufacturing and housing. I do think that that's going to start filtering through. And we do think that the news on the economy is going to be probably disappointing over the next few months as we see these effects take hold.
With that in mind, Rabila, does the spread between where Fed funds will be after today and where the 2-year is right now? Does that spread, that inversion make sense?
You know, we've talked about this before, what the markets are expecting and what the Fed is communicating. They're just not on the same page. It doesn't make sense, but maybe this gets resolved as the Fed continues to deliver on its promise, that the funds rate moves closer to 5%. Maybe at that point, the markets adjust. And then, you know, then you've got the other side of it is the message, you know, the higher for longer message, and whether that resonates with the markets or not. Right now, the markets are pushing back. They've been pushing back for a while. But I do think this will have to get resolved as we move closer to that peak rate and we move beyond that. And the Fed continues to communicate that rates will remain in restricted territory for some time.
That won't be resolved with words today. That will be resolved with actions. That will be resolved with time. So, Rabia, with that in mind, how long do you think that spread between the market and the Fed can persist?
You know, what we've seen is that the market is just not believing what the Fed is saying. So, yeah, I think that can persist until we get to that terminal point. The issue really is, you know, and I think maybe what we should understand is that, you know, the Fed's message today, we expect it to be hawkish from Chair Powell, right? He's going to push back against the rhetoric of the pivot towards easier rates. Maybe what's really more important right now is to see what the Fed and what Fed officials are going to signal in the March dot plot. I know they try to, you know, they don't want to overemphasize the dot plot, but it has been a communications tool, right? So how many, you know, what is that terminal rate in March? And how many, if any, Fed officials expect easier policy, you know, in 2023? So I think those things are going to be important. You know, I don't think the communication is going to change. I don't think the market pushback is going to change. I think it can persist probably until we get to that terminal rate. But we really do need to, you know, the Fed needs to be very careful in its communications. There has been that disconnect because the minute they say that they are going to pause, the market is going to be even more convinced that a pivot to easier policy is imminent.
Which is the reason why this is really a gamesmanship moment between the Fed and the market. So let's talk about the data. We have both Bank of America and Morgan Stanley coming out and saying that jobs have to fall below 100,000 on a monthly basis in terms of job creation before the Fed can feel confident that they're getting to the place that they need to be with respect to slowing the economy. How close to that are we?
We're not close at all. I mean, you know, the U.S. economy is creating jobs at a very rapid pace. We're still seeing extremely strong job demand for workers. That is apparent in the jobless claims numbers. I know we could be talking about the adjustment in job openings, but they are extremely elevated, 1.7 openings to every unemployed person. So, I mean, we're seeing a very, very slow adjustment despite over 400 basis points of tightening. So, I don't think this is imminent. Maybe we do get a downside surprise on Friday, but I do think that there is a lot of demand for workers still that needs to be resolved with what we're seeing on the supply side.
So how do you push back against the people in the market who say even without jobs coming down, even without the sort of pain that the Fed has talked about, we're seeing this disinflation that feels sustainable? Some people actually coming out yesterday and saying that if you look at certain metrics, inflation now is too low relative to some of the Fed's metrics. How do you push back against that?
You know, what we're seeing in the inflation numbers, it's, you know, we've adjusted down from that 9% to the 6%, right, range. But where we go from here, I mean, that is what is important, and that is what's going to take some time. And this isn't the Fed's estimates, this is in our estimates. We just don't see that adjustment happening. Wage growth is still very, very, you know, very elevated, well above where it needs to be in terms of being consistent with the 2% target. So yes, inflation